Over 4% for the 10-year, the benchmark there. Brent crude oil currently $84 a barrel. The softer China data, of course, in terms of imports and exports. Imports down for 5 straight months. A drop there for crude of around 0.8%. Let's look at how futures are squaring up then after the gains of yesterday in the US. Yes, you had the weak China data, but also a reminder of the fragility around the real estate sector as well, given Country Garden and reports that it's missed a payment there, something that would have been unthinkable just 2 years ago. The DAX futures pointing lower by 0.5. FTSE 100 off by 37 points, down by 0.5%. Over in France, you're looking at losses as well. So let's just give these markets a couple of seconds to reflect some of the headlines coming through and to price, of course, at the open. The Spanish IBEX currently down 0.6%, moving lower by 57 points. Over in Spain. Here in the UK, the FTSE 100 off by 0.4%. That's a drop by 29 points. We'll move it on to the sectors, and these things are shaking out, of course, across these main sectors as well. As we weigh up not just, of course, the data and the reminder of the weakness coming out of China, but also the commentary from Michelle Bowman of the Fed as we lead up to that CPI print out of the US on Thursday, and a reminder as well of the news out of Italy, that tax on banks, something that's a surprise there coming through from a package of details and policies coming through, initiatives from the government of Meloni, and in focus, of course, the banking sector in Italy this morning. The tech sector is currently down 0.4%, but it's basic resources taking the biggest hit. You tie that to the China data, down 1.5%. In that sector, so real pain again for commodities. And a reminder as well, Glencore and its earnings weak on the back of those softer commodities prices. Also touching on banks, we'll unpick the Italy story there, down 1% as a sector. Also seeing losses in autos down 0.8%. Again, risk off across these sectors, the main indexes as well, reflecting the moves lower in stocks, at least so far in the first few seconds of the open. Let's get some more details in terms of the themes that are running through these markets with Sam Anstead from our Markets Today blog. Sam, let's start with the Italy story then. A surprise in terms of what looked like, or what is looking like, a windfall tax on Italian banks.
Yeah, I mean, not just a surprise, but quite a negative surprise. You know, I mean, it really did kind of come out of nowhere. I think what you have to remember with Italian banks, this has been a major part of their attraction over the course of the last year or so. They've outperformed quite significantly. They cut costs very significantly. So the interest rate benefit that they've got on the bottom line has been very significant. I wouldn't be surprised if this not only hits Italian banks today, but this sends a little bit of a shiver of sort of worse sentiment through some other banking sectors today. So the IBEX is a little bit lower today. Wouldn't be surprised if you see a couple of the Spanish banks go down, also quite rate sensitive. So yeah, it's certainly from sentiment point of view, it's pretty negative.
Yeah, indeed. Here in the UK, Sam, a focus on what's been happening in terms of some comments from the BOE's Hugh Pill on the inflation dynamics of the UK, as we all, of course, desperately look for substantial moves lower in inflation and prices here in the UK. And he's suggesting that maybe food prices are going to remain elevated for some time.
Yeah, and food prices have been one of the major areas of inflation, right? So even, you know, every time you get a new inflation report out, yes, it's slowing a little bit, but for the most part, food price inflation has remained well into the double digits. And I think his comments yesterday, you know, most of them about this persistence of inflation that the BOE talked about a little bit last week, but reiterating that particularly for food prices and for households is not a great sign, because they are obviously waiting for anything to grab onto, that prices are starting to ease and at some point hopefully going to come back down again. But certainly at the moment doesn't seem like that's on the horizon. Still looking at double-digit gains for food prices towards the end of the year, so mid to long term as well, in terms of higher food prices here in the UK. Sam Anstead, thank you very much indeed, of course, from our Markets Today blog. You can get more, of course, from the team, Sam and the team, on the front page of the Bloomberg UK website, or by typing TLive Go
on the terminal. Let's check in on some of the individual stocks on the move. Joe Easton had, of course, flagged for us Italian banks, and we look at that story. Sam giving us some of the details around that surprise in terms of the taxes. Joe, how are things shaping up across these individual stocks?
These are how the main earnings stories are opening up in the first few minutes of trading. Glencore dropping about 2.7%. Now they are reporting their earnings for the full year could be around half of what they were in the previous year. Their dividends also pretty weak in terms of what analysts were expecting. Aberdeen, meanwhile, they're seeing some big outflows in terms of their funds. They haven't been able to stop that. We spoke to the CEO earlier today about that one, of course. IHG, meanwhile, up 1.4%. They're saying there hasn't been a weakening in any of the consumer demand in terms of the outlook for travel. They're the owner of Crown Plaza and Holiday Inn. Obviously, I'm more of a Holiday Inn man myself. Bayer, that one looked pretty weak to me, but actually not as bad as expected. They did actually guide on their earnings not too long ago, around 2 weeks ago. So a lot of that priced in. They've cut their guidance as well in terms of the big chemicals company there. We're also going to look at a few ratings changes, I believe. We're going to bring those ones up. Smurfit Kappa. Now, this one, it's a new overweight at Barclays who say their margins are better than some of their packaging peers. So packaging obviously doesn't sound very glamorous, but it's pretty important in terms of online retail. That one not really reacting to that, probably moving with the market as well. DS Smith, they had a rating on as well. That one's at equal weight, around 1.5%. And WPP downgraded at Deutsche Bank. This is after that really negative earnings report as some of their tech clients cut back on spending given the concerns around advertising at the moment. Finally, we're looking at some other chemicals. So away from Bayer, there was International Flavors and Fragrances from the US, a big company, dropping around 19% in the US aftermarket yesterday, and that is hitting a bunch of peers today. Givaudan, Croda and Simrise, a couple of others were on the screen earlier. Chemicals, again, it's not getting better over there for that one, but the broader story is the Italian bank story, and that's really hitting a lot of sectors today, I think.
Yeah, and we'll keep across the Italian banks. I don't know why you assume that you and that we should know that you're a Holiday Inn man, Joe. I had you there quaffing cocktails in the Crown Plaza. Joe Easton, thank you very much indeed, of course, from our equities team. Comprehensive as ever. Let's get back to one of the main data points of the day then, the China data, the trade data, weighing, of course, on those markets as concerns grow over the world's second largest economy. Just to remind, how many times have we said that in the last few months? It continues this story. China's exports fell for a third straight month, while imports plunged as domestic pressures undermine the country's stuttering post-pandemic recovery. Let's bring in Bloomberg's China economy and government editor Jill Jesus in Hong Kong. Jill, just how bad are these numbers? For me, the imports really stood out.
Hey, Tom. Yeah, I definitely think we need to pay attention to those import figures. Of course, exports, we've known that this was not going to be a major driver of China's economy this year, just given that we haven't seen that big post-pandemic demand boom for China's exports that we saw in prior years. But yes, so ultimately that import figure falling some 12% or so year on year in July, much worse than what economists are expecting. I think this is really just pointing again to that ongoing issue with demand, domestic demand within China. I mean, you know, we've talked to some economists who have also pointed to falling, you know, there's continuing weakness in commodity prices. Chinese factories are importing materials, they're buying materials, but at lower prices, and so that's factoring in there. But ultimately, what we've seen in China this year is, I think, as you pointed out a bit earlier about this, you know, this continuing narrative of this slowdown in the recovery. We were expecting consumption to really drive the recovery this year, and we just haven't really seen a lot of that hold up. We've seen the economy losing steam in large part because, you know, I mean, confidence is still really weak. People aren't spending as much money as we think they should be. You know, they're saving money, and so ultimately that's feeding through into these export figures, and again, may also feed into, you know, we're expecting some inflation data tomorrow, expectations for China to consumer prices to fall into deflation for the first time in quite a while. So it's all kind of coming together and you know, really serving that demand issue there.
Yeah, and the drumbeat, of course, of rhetoric out of Beijing in terms of the steps needed to improve the economy. Does this put a gun to the head of officials to really get them to step up that support, Jill?
I mean, I think at this point, Tom, they've been very, very, very clear. They do not want to roll out any kind of massive stimulus programs. I really wouldn't expect something like China to start cutting checks for people, trying to get them to spend more money. They've been very deliberate with this idea of they want targeted and limited support. What we've seen out of the government so far, at least in terms of consumption, boosting demand, is a lot of encouragement to local officials to try to get people to buy more home goods, to try to spend more money on sort of those concrete items, because while people are going out to restaurants and spending money on services, for example, we're not seeing that spending translate through to goods. I think that we'll likely see those types of incremental measures continue, but economists are also saying that maybe we'll see imports tick up a little bit more toward the back end of the year, but ultimately maybe again more support, but I wouldn't expect anything insanely huge or anything like that.
Okay, Jill, before we get to our next question, our final question with you, I just want to check in for our viewers on Italian stocks. Italian banks, of course, after that surprise increase in taxes, a windfall tax of sorts on the Italian banking sector being pushed through by Meloni and her cabinet. And you're seeing a sharp move lower in banking stocks in Italy. Intesa Sanpaolo down 7.2%, Unicredit falling around 6.5%, Unicredit down currently now at 5.5%. Their losses slightly heavier over on Intesa Sanpaolo. So you are seeing an immediate effect, of course, and reaction from Italian banks to that surprise increase in taxes, that levy on Italian banks from, of course, the government of Meloni, and we're seeing that reflected in the stock prices right now. We'll continue to keep across this story for you, of course, throughout the morning. Jill, before we let you go, you talked about the need for the consumer to feel more confident in China. That's not going to happen if the real estate market remains weak, and we're getting a reminder of the fragility there with Country Garden and reports that the sixth largest real estate developer in China missing $2 bond payments. This is significant.
Yes, you're exactly right, Tom. I think that at this point, what we're seeing, these reports about missing these payments from Country Garden, we've already had some recent liquidity concerns with this developer, just given that they didn't scrap a planned share sale. Ultimately, yes, I mean, look, this is a company that, as you said, is China's sixth largest developer by sales. They've got a lot of active projects. If there's any concerns about Country Garden, potentially failing, that certainly has widespread ramifications for the rest of China's property market, which, as we all know, has been doing terribly for several years now. So, at this point really speaks to, we've seen some measures of support from the Chinese government trying to help the property sector. You were asking about support earlier. I'd argue that really it's that property sector where we've seen the most support from China. We just saw the central bank last week meet with some major developers trying to talk through how they can help them with financing and some of their liquidity issues. So ultimately, yes, I think that at this point, certainly some signs of fragility there with Country Garden, but I would expect, maybe in the coming weeks and months, we'll see some more support from the property sector side from the government.
Yeah, you don't have to cast your eye back too far. 2-3 years, and you were in a time and place when investors would have assumed that dollar bonds from US or Chinese real estate companies were essentially safe as houses. Not so much anymore. Jill Deasons, thank you very much indeed. Bloomberg's China economy and government editor, of course, with the latest on the data out of China and Country Garden's woes there in terms of reports of missed bond payments. Coming up, are more rate hikes in store in the US then? We're looking ahead, of course, to CPI out later, of course, this week on Thursday. We're going to get the views as well from Morgan Stanley's Michael Wilson, Fed Governor Michelle Bowman as well, and some analysis from Tatiana Gray-Castro as well from Muzinich. Stay with us for that. This is Bloomberg.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You gotta be, you gotta show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't wanna do this. You gotta show up. You gotta be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
This is Bloomberg.
I supported raising the federal funds rate at our July meeting, and I expect that additional increases will likely be needed to lower inflation to the FOMC's goal. I'll be looking for evidence that inflation is on a consistent and meaningful downward path as I consider whether further increases in the federal funds rate will be needed and how long the federal funds rate will need to remain at a sufficiently restrictive level.
They're doing 8% budget deficit spending when you have 3.5% unemployment. I mean, that's really unprecedented. I just think this boom-bust thesis is so correct, and maybe the market's looking through it to the other side. Look, that's a risky proposition given where valuations are. It was a great idea to buy stocks last fall. We traded it. We didn't stick with it long enough. Okay, but I think at this stage you need to be very selective.
Okay, that, of course, was Morgan Stanley's Michael Wilson and Fed Governor Michelle Bowman giving their thoughts on the U.S. economy and the rates path ahead. Let's get another view now and bring in Tatiana Grail Castro, Portfolio Manager and Co-Head of Public Markets at Muzinich & Co. Tatiana, great to see you in the studio. Thanks for coming in. Give us your update, your understanding now of where the Fed goes next as we look ahead to the CPI print out of the U.S. on Thursday.
So clearly it depends on the print, but we do think that they are sort of there, right? So for us, the biggest thought process goes along the shape of the curve, and we have seen quite a lot of re-steepening over the last few weeks. So clearly,
bear steepening, characterized as bear steepening.
Exactly. And for us, it is really how long will that continue? And then even if we have a bullish steepening, maybe, or a bullish flattening, what is going to win out? So I think we're already in the next step where we say the bear steepening could continue a little bit more, and that is if this soft landing is true, if that is actually indeed the case, that we see a soft landing, then the curve is too inverted. And it is the long end that is likely to take most of the brunt in that regard. But we are not even that sure that this soft landing is indeed going to be the narrative for very much longer. What gives you that skepticism around the soft landing, almost consensus now that's formed over the last few weeks? Well, it is actually odd that, and I think it is a part of the phase. So in the next few months, we will see the data see as a soft landing, but then going forward, as interest rates are coming through, and the longer end is going higher on the soft landing narrative, we do expect there to be a slowdown in economic stimulus and demand. And in that regard, then, what is then the next step for the curve? Where will it move, or how will it move? Okay, but for now, you think there are legs, maybe, to this bear steepening that we've seen, very pronounced, of course, last week. You think that has further to run for now? I think for for the US economy to slow down. It is probably for another few weeks the case that we see continued bear steepening. That is sort of the base case for us, and that's how we are positioned.
What do you make of this Moody's decision then to downgrade these US banks? Because they're citing the credit risks around real estate, the risks around higher funding costs, and those real estate risks being part of the rationale for the downgrade. Is this kind of forward-looking moves by Moody's? They're playing catch-up to this theme. Are we potentially looking at a credit event later this year?
Yeah, I agree. The timing seems a bit odd, right? So it's a few months after the turmoil in the U.S. regional bank, and during the soft lending narrative. So I mean, I give them credit and say, you know, they're forward-looking, and that is what they anticipate, that there is a slowdown, and the real estate market, especially the commercial real estate market in the U.S., is somewhat under pressure. So yeah, I would sort of give them the benefit of the doubt and say this is a forward-looking statement for them, and I can understand why they sort of have concerns, even so they haven't fully played out at the moment.
What about credit spreads? Is there further widening in credit spreads? Are you attracted by the offerings of high yield? How much quality do you want to be looking at when it comes to the credit space at this point?
I mean, we have actually had been reducing credit risk, and I think as many and have been caught out by credit spreads performing really well. So we didn't fully participate in that spread tightening over the last, year to date, really. But we haven't changed our stance. If anything, we continue to go up the credit quality, and that is because of this very strong rally that has been completely anticipated. And we would expect there to be a tendency of profit-taking, given the sort of, you know, the lack of returns that we have seen for 2023 so far. And so, yeah, maybe a little bit of pause of credit spread tightening, but at the same time, there could be some widening towards the end.
And the Bank of Japan, meanwhile, edging towards, it seems, a very gradual removal, at least for now, of yield curve control. Is there an opportunity in Japan as funds flow back to that economy?
Well, we would see it less as an opportunity for us, but we would see it as, clearly the Japanese market, or the Japanese being the biggest buyer of treasuries. They have surpassed actually the Chinese in terms of holders of treasuries. And to the extent that the change in yield curve could also be help appreciate the yen, then clearly dollar assets, a combination of yield and currency moves, may look less attractive for Japanese investors. So there could be, some further pressure on the demand for treasury.
Okay, so further pressure potentially coming through from the BOJ, at least investors or holders, Japanese holders, of course, of US Treasuries at a time, of course, when there's huge issuance coming through from the US Treasury as well. Tatiana, thank you very much indeed. Tatiana Grael-Castro, Portfolio Manager and co-head of public markets at Muzinich & Co. We're just checking in on Italian banks after that surprise increase in taxes on Italian lenders. And you're seeing sharp moves, of course, in Italian banks on the back of that news. Down 7% on UniCredit. That's a drop being felt there in that stock. Intesa Sanpaolo currently down 8.3%. So some pretty heavy selling coming through on Italian banks. Again, on the back of that surprise move of additional taxes on the Italian banking system. It's a story we will keep across for you, of course. Stay with us. This is Bloomberg.
In 2018, the IPCC did what was called the 1.5 report. What was the difference between what a 2-degree world looked like and what a 1.5 degree world? And the catastrophe to the planet between those two poles led everybody to conclude that actually the job is bigger. We have to go to net zero. And that's a transformation of the global economy on the size and scale that's never occurred in human history. So that's a kind of daunting task, but it's full, I think, also of challenge, opportunity, the chance for innovation, and the chance to have the private sector play a fundamental role in making that change happen.
On the next episode of The Circuit.
I was like, this is a way to change culture. Like, what a different world. Of course, we know for girls, it means so much to have female athletes to look up to, but for boys, to look up to women also, it's really for everyone.
Watch The Circuit with Emily Chang, Thursdays, 10 p.m. Eastern on Bloomberg Television, or 8 p.m. Eastern on Bloomberg.com or the Bloomberg app on connected TVs.
Authorities
could face bigger challenges next.
It was going to keep rain World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make.
Welcome back. 24 minutes into your trading day this Tuesday, European trading day, of course, and you're seeing losses across these markets, risk off, and losses pronounced in Italy. The FTSE Mid currently down a little over 2% on the back of that tax story for Italian banks. Let's get to some of the top stories on the Bloomberg terminal, though, as we weigh up some of the key themes as well, running through these markets, but a focus as well on what is happening on the earnings front. Bloomberg sources say TSMC's board is expected to sign off today on the construction of a factory in the German city of Dresden worth 10 billion euros. The news was first reported by Germany's Handelsblatt newspaper. The German government will provide as much as 5 billion euros in subsidies for the plant, which will specialize in making chips for the auto sector. Meanwhile, on autos, Tesla CFO Zachary Kirkhorn has stepped down after 13 years at the EV maker. This is a surprise shakeup that does raise questions about succession in the top ranks of Elon Musk's company. Kirkhorn will continue to serve in an unspecified capacity through the end of the year to, quote, support a seamless transition. And HSBC drew criticism from British lawmakers after its head of public affairs accused the UK government of being, quote, weak by following US policy on China. Gerard Coles told a private event in London in June that the UK would often bow to the demands of Washington and had been strong-armed into cutting back business dealings with China. In a statement, Gerard Coles apologised, quote, for any offence caused. A big story for us today, Italian banks. And I mentioned the FTSE Mid down a little over 2%. The Italian banking sector then under pressure. This is a surprise windfall tax on Italian lenders being pushed through as part of a package of measures by Giorgia Meloni. You're seeing the likes of UniCredit currently down 7%, a little over 7%. Intesa Sanpaolo off by 8.2%. As you can see as well, Banco BPM off by 8.5%. So some heavy losses coming through. It looks like a 40% tax on the profits of the banking sector for the year of 2023. We'll hope to get more details on this, of course, in the minutes and hours ahead. A major story for us as Italian banks feel the pressure on the back of that surprise tax increase. Stay with us. This is Bloomberg.
Manchester, not London, is the best place to find a new job in the UK. That's the surprising finding of data analysed by Bloomberg from Reed Recruitment. While you might think that London is the biggest pool of jobs, which it is, Manchester is leading the way when you look at the number of jobs per local worker. Thousands of voters in the so-called Red Wall seats flipped Conservative in the last election, hoping that the Conservative government would be able to bring more wealth and prosperity to their area. However, the data still show a country where employment prospects are thin on the ground in large pockets of the northeast, northwest, and areas all around the coast. Aside from Manchester, the only areas that are really leading the way are Cambridge, Reading, and Milton Keynes, indicating the good news for the rest of the UK might stop there. With Prime Minister Rishi Sunak facing the prospect of a general election as soon as next year, the pressure's now on for him to find ways to spread wealth outside of London to some of those more neglected areas. In Chancellor Jeremy Hunt's budget, he unveiled plans for 12 new low-tax investment zones around the UK and £760 million of spending on infrastructure and regeneration. Manchester's one of the oldest devolved areas in England, and there are signs that that's really beginning to pay off. What's on Jeremy Hunt's plate now is whether he can spread that success to other regions.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Markets Today. We are 30 minutes into your European trading day, and the top stories. Banks plunge as Italy surprises with a new tax on lenders' windfall profits, spooking the markets. Double whammy, China's exports fall for a third straight month thanks to slower global demand, while imports plunge in a new blow to the nation's economic recovery. Plus, Glencore slips as the mining giant sees a steep drop in first-half profit and slashes its returns to shareholders amid disappointing Chinese growth. Let's check in on these markets then. Risk off, moves out of equities, moves into the US dollar, moves into bonds. Treasury yields are coming in lower across the curve. And here's the picture across the equities market then. The benchmark in Europe is down by 0.3%. But of course, the European story really is focused on two aspects: China and then Italy and that windfall tax on bank profits. The DAX down 39 points, off by 0.2%. Of course, the linkages between that economy, Europe's largest economy, and of course, the Chinese economy at the forefront of oil. Autos taking a hit on the back of some of the news out of China. The FTSE 100 is off by 13 points, down 0.2%. Let's flip it over and have a look at how things are shaping up across the sectors then, with a particular focus on basic resources. Given the weakness in terms of imports, 5 straight months where imports have fallen. Imports into China falling for 5 straight months. The export story, of course, continues to be weak as well, but imports obviously consequential for the European markets. And we're looking at basic resources currently down 1.3%. We talked about the story around Glencore and the hit to profits there on softer commodities. A couple of sectors are in the green though. Food up 0.4%, and utilities, that safe haven play, gaining 0.6%. Autos now flat. The pay trade, of course, in banks down 1.9%, of course, with Italian lenders falling sharply on the back of that surprise Italian tax windfall. We'll get details on that move by Giorgio Maloney on Italian banks just in the next couple of minutes. Let's check in on some of the individual stocks on the move, though, with Joe Easton, who's been, of course, always keeping an eagle eye on some of these individual stories. Italian banks then, Joe, talk to us about how the pain trade is flowing through on the back of that surprise tax increase.
So there's not much to be happy about in these financial stocks this morning. Tom, in Intesa Sanpaolo, one of the biggest gainers dropping, one of the biggest decliners dropping around 8%. We're also seeing similar falls in BPER over in Milan as well. Some of these drops are the biggest in around 5 months, according to our data. And I've just read Bloomberg Intelligence reports just out saying that this tax move could shave at around 10% of the earnings, given the tax increase that's going to be hitting these companies. And as you say, we're seeing a bit of a read across as well, not just Italian banks declining. We're going to flip over and have a look at some of the other peers as well. Some of the Spanish lenders hit. We're seeing Sabadell and Santander almost down 2%, seeing a flow through into France as well with Credit Agricole dropping. So a swathe of European lenders are falling on this news. Some concern that other governments will follow Italy with such a move. Barclays have also brought up as well. They've been downgraded. Separate news over at Exane BNP Paribas, who are saying that rising rates in the UK are becoming dangerous for these lenders now and will start to hit some of those profits. So the banking sector, where all the action is. We've also got in the financials, Aberdeen, of course. Now they're reporting a big drop in flows. The asset manager, the big UK asset manager based up in Scotland, down 6%. That one is dropping today. We spoke to the CEO earlier today. Have a listen to what he had to say.
In the first half, we grew revenues 4% and we grew earnings by 10%. That's a really good performance in this type of environment, a very difficult environment. And it's a testimony to the stronger business model. Why were we able to grow revenues and earnings in the half? Because the strength within our advisor business and within the personal business.
So Aberdeen CEO speaking there, Tom, and that stock, as I say, down around 6%, the worst performer on the FTSE 100, and actually has no buy ratings on that stock at all. So a lot of negativity coming in for that one, and the outflows are continuing, weighing on that stock this morning.
Okay, Joe Easton from our equities team, thank you very much indeed. Yet the CEO of Aberdeen trying to make the bullish case for the restructuring plans at that business, but the outflows seem to be in focus again for investors. Those outflows coming in higher than the estimates. Joe, of course, thank you. Joe mentioned Italian lenders, of course, have slumped at the open. That's after Italian Prime Minister Giorgia Meloni's cabinet approved a surprise tax on the, quote, extra profits of banks this year. For more, let's bring in Bloomberg's senior finance editor then, Stefania Bianchi. Stefania, what do these new measures mean for Italian banks then? What are the details? I'm reading 40% on extra profits. What are the expectations around how this actually plays out for Italian lenders?
Well, as you can see this morning, this isn't good news for Italian banks. Stocks are down. It was a surprise move. It was Giorgia Meloni's parting gift before the summer break. Wasn't expected. And as you say, it's a 40% tax on multi-billion euro earnings. And this is expected to go towards finance cuts and support for mortgages for first-time buyers. And it's expected to add about 2 billion euros to state coffers, which I expect is much needed in Italy. As Joe mentioned earlier as well, Bloomberg Intelligence estimates that about 10% could be shaved off bank earnings for this year. So it really isn't good news for Italian banks, and markets are really showing that.
And the rationale, presumably, from those in the Italian cabinet would be, look, as a sector, you've performed relatively well. You have generated decent profits. There's a resiliency in much of the Italian banking sector. Does that continue? How well-founded is that? How vulnerable are these banks to this additional windfall tax, Stefania?
That's right. As you say, they've done pretty well. Earnings have, across Europe, they've been benefiting from higher interest rates. So I guess the thinking behind this is, well, now you're doing well, so now is a good time to really benefit from these higher interest rates and take what we can. And as Joe mentioned as well, this could perhaps spread across Europe, and maybe Spain and elsewhere could introduce such measures.
Yeah, that will be something, no doubt, investors will be watching very closely indeed, and you're seeing that ripple across, as you mentioned, to Spanish banks as well on the back of this news. Is it something that officials in Madrid are now considering as well? Will they mirror this policy? Bloomberg's senior finance editor, Stefania Bianchi, on that surprise tax increase, of course, for Italian banks. Thank you. Coming up, we're going to take a look at the private equity world and the deal-making struggles now that the boom is over. An important interview coming up. Stay with us. This is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
Welcome to Balance of Power. This is Bloomberg. Season is here.
Another crazy busy week.
There's still a lot of uncertainty.
The market knows that there's bad things coming.
Bloomberg breaks the numbers first.
A slew of earnings.
Some breaking earnings.
What did we learn from earnings? I mean, a lot of them beat. Some of them got slammed.
With exclusive expert analysis.
This is a growth story.
Advertisers are pulling back. It certainly will be a headwind.
Good revenue growth across the globe. A record year.
We haven't seen a result like that since a decade.
We're not standing still.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
This is Markets Today, 41 minutes into your European trading day. Risk-off moves into the dollar, moves into US Treasuries, and equities are down. Across the European benchmark, drops of 0.4%. The trade data, just a reminder of the vulnerability, the weakness coming out of China, particularly in terms of imports, both exports and imports coming in lower than had been expected. 5 straight months now of contracting imports for the world's second largest economy. A reminder as well about the fragilities in the real estate sector for that economy, with Country Garden apparently and reportedly missing payments. It's one of the biggest real estate developers in China. And then you had the surprise tax increase on Italian banks. That is rippling across the banking sector of Europe. The Italian FTSE MIB currently down 1.7%, and Italian banks taking a big hit on the back of that news. You can see Intesa Sanpaolo down 7.6%, UniCredit taking a hit of 6.2% as well. We will continue to monitor this story. It's expected to be a 40% windfall tax on the additional profits. How you define those, of course, remains open to question. Additional profits of Italian banks for 2023. But you're seeing Spanish lenders taking a hit as well, moving lower on concerns from investors that maybe this is a policy that other European lawmakers will look to mirror. This is a major story for us as we continue to weigh up the data picture out of China, but also looking ahead to the CPI inflation print out of the US on Thursday, as Michelle Bowman of the Fed reminded us that some on the FOMC remain determined to go higher, potentially with rates for that economy. Today, though, yields are moving lower across the Treasury curve, particularly pronounced at the 10-year and 30-year, the long end, of course, just over 4% on the US 10-year, 4.18% on the 30-year. We'll be back with another important look at the private equity market, the funding concerns there, the deal making. Is anything starting to turn in the world of PE? An important conversation coming up in just the next couple of minutes. Stay with us. This is Bloomberg.
everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
From New York City, from London, in Sydney, from Washington, in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Welcome back. This is Markets. Today we are 46 minutes into the European trading day. Risk off as you see European equities lower. The data out of China and then the surprise tax increase on Italian banks. A ripple effect there across the European banking sector. Now, the earnings season has, of course, been a difficult one for the large listed private equity giants. KKR reported yesterday that earnings fell 23% in the second quarter thanks to a deal-making drought. Last week, Apollo's chief declared, quote, the end of an era for private equity. Joining us now is Bloomberg's Danny Berger and Oliver Harman, the founding partner of Searchlight Capital Partners. It's a private capital and debt shop with about $12 billion under management. Danny.
Tom, thank you very much. Those are great way to set us up. I mean, Oliver, some harsh words from Mark Rowan over at Apollo. Do you agree with him? Is this the end of an era for private equity?
Well, look, first of all, it's an end of an era for a lot of things, right? I mean, we've been through some of the craziest times you can imagine as an investor, as a human over the last 5 years, given the pandemic, the subsequent Russian invasion of Ukraine, the energy crisis that fell from that, the cost of living crisis. And then on top of that, you know, we emerged from all of that. The climate volatility has gotten crazier. People are now looking at AI and how that's disrupting lots of industries. So it's an end of an era and a new era for many, many parts of the economy and constantly challenging you to think in new ways, which is interesting.
I also think just Searchlight's history is interesting in this study because you started it about 14 years ago. It really was the start of this boom cycle for private equity. Yes. If I could say, Oliver, would you do the same today? Would you start Searchlight today, would you?
Absolutely, yeah, absolutely. I think we had a great platform. You know, one of my co-founders was at Apollo for a long time, worked closely with Mark. I was obviously at KKR. The third co-founder was in Ontario Teachers Pensions. So we've got a great platform. We built an international business across Europe and North America, and we've been able to stay flexible and find really interesting opportunities that are out of the common, ordinary way of looking at things.
So what do you have to do different in this environment? I know you have a hybrid capital approach. What do you have to do differently in this environment with the changes you were just laying out?
Well, you have to be innovative. You have to stop thinking on conventional themes. I think Mark was probably hitting on some of the points around higher interest rates. You know, obviously higher interest rates impact all businesses, especially if you're valuing a company, because if you're valuing a company, often you're going to look at the future value. If it's cash flow, you might be discounting them back to the present. You'll be using a higher cost of capital just as a function of higher interest rates, which puts downward pressure on valuations. So as an investor, you have even more focus on finding businesses that have fundamental, attractive growth attached to them. And also that you think you can buy at an attractive risk reward in this environment.
One of the things that also impacts, though, are the many companies that are going to come up for refinancing next year that are going to hit maturity walls. Yes. What does that mean for you as a fund?
Well, obviously, you know, maturity walls have a lot to do with debt is coming due. You know, it's a term that people use. The debt's coming due, and what does a company do at that point? Either it pays off its debt. That's hard to do. Sometimes you're not going to have that massive pile of cash sitting on your balance sheet. So often you have to refinance. You know, that's classically what happens. You know, it's what governments do too with their treasuries or guilds. And that gets harder to do if interest rates are higher because by definition, the cost of refinancing it is going to be higher than what you're currently paying, which means your earnings are probably going to come down. And the only way to invent that is to actually do other things, either drive more growth that can make up for that earnings shortfall, or to cut costs. You know, so I think it's going to put a lot of pressure on companies. It presents opportunities for funds like us to help them potentially with additional capital to find those growth strategies, which will allow them to refinance the debt and continue to grow into the future, to offer great services, great products, and employ lots of interesting and talented people.
So what does that look like? So are you looking for those sort of bolt-on acquisitions? Is that what it is? Are you cutting costs across all of your companies now to cope with that?
Well, look, what it fundamentally means is that you have to be creative in creating value. We have definitely been very aggressive in some instances buying companies for our businesses. You know, often when in tough times like this, you can often buy a competitive business at maybe a lower price than you would have in the past. That allows the companies that we own to take those businesses, integrate the best products and services, build a larger platform, create safer jobs for everyone in the total company. Of course, we have to have some efficiencies through cost synergies, but mainly they're growth driven. Also repositioning those companies into higher growth sectors.
That's also interesting you're finding good deals there, because I thought part of the conversation is that valuations actually didn't come down that much in the COVID back. So you are actually finding cheap things.
Well, I think valuation is one of those things, people look at the market indices, right? And they talk, oh, valuations are this way and that way. And of course, the market indices right now have been up. A lot of it has been driven by, as we know, big name firms, a lot of it driven by tech, a lot of AI stories and a lot of AI hype in some instances, and a lot of AI reality. We found that there's real opportunity in public equities, often in the smaller to mid-cap stocks that are often ignored by banks and equity research analysts that often don't pull in a huge base of retail investors. And those shares are often a lot cheaper than they have been historically and much more attractive to acquire as a result of that.
Yeah, I mean, Gresham House last month, you announced that you were going to take that one private. It is take private specifically in the UK too, because this isn't the only one you've done recently. Is that the opportunity set right now?
Well, we've been very active in public to privates as a firm. So we've done public to privates probably in more jurisdictions than just about any other firm. We've done it in the US, Canada, Sweden, UK. We think often we can find really interesting and attractive businesses that are ignored, undervalued by the public markets. We feel we can come with a vision because we can sit down with management, look at a 5-year plan, look at 5 years of, hey, what can we do with this business to grow it, to make it better and more profitable, and also offer better products and services to customers. And that allows management to focus on medium-term success, not just every quarter, what am I going to do quarter by quarter, what am I going to have to announce? That can often drain energy, it can lead to short-term decision-making and not as much strategic thinking. So often we can actually come to these businesses with a longer-term plan that makes a lot of sense, that they're excited to get behind.
And I get that, especially with an asset manager who would say, why would you judge us quarter by quarter when our own investors are in these funds for the long term?
Yeah. Obviously, that company hasn't closed yet. You know, we've have a board-recommended bid that's been announced and is going to a shareholder vote at the end of August. But fundamentally, yes, that's also a business that's focused on green energy and sustainability, which also is a long-term growth sector. And Hive, you know, was a really, really attractive business in a sector that we really know, global events. And on the back of that, you know, we think there's a lot we can do because it's positioned in growth industries. And if we've learned one thing coming out of COVID, people love to connect. People love to go to conferences, see their colleagues. It's also super efficient. You're at a conference, you can see your colleagues from all around the world, competitors, customers, suppliers. You don't have to do a lot of travel. It's also more economically efficient, also ecologically more efficient in many ways.
And it means you can join us live here on the Bloomberg TV set. Oliver, we're going to have to wrap it up.
To do, yes.
Thank you so much for joining. Really appreciate your time. And Tom, yes, that was Oliver Harmon, the founding partner.
Really interesting in terms of the fundraising environment, in terms of valuations, in terms of the opportunities around moving from public to private as well. Oliver, thank you very much indeed. And of course, Danny Berger for bringing us that fantastic interview, those insights into the world of PE. Right, we'll get back to what is happening, of course, in Italy. Italy's government has spooked markets with an unexpected windfall tax on banks' profits, and we're going to cross over to the reporter for a focus, of course, and the details in terms of that surprise move by Giorgia Meloni and her cabinet. I believe we have a reporter standing by who's going to break this story down for us as you look, of course, at the selling pressure on those Italian lenders. Let's bring in our Western Europe economy reporter, Alessandro Migliaccio in Rome. Alessandro, what happened then?
what happened? A big surprise. This was really unexpected. There had been some noise in the government about doing something like this, but it was not in any of the drafts we'd seen, not in any of the drafts any of the, senior government reporters had seen, even the ones close to the government. So it seems to be some kind of coup, if you can't put it that way, from the populist part of Meloni's government. Deputy Minister Salvini, who's the leader of the League Party, he announced the move. It was not the finance minister, Giorgetti, and neither did the finance minister actually go to the press conference late last night. So we were a bit surprised. Salvini did say that Giorgetti proposed this, but it's very strange that he would, because of the impact that it's going to have on banks. I mean, clearly, if this norm really comes about, and I say that because in the past there have been attempts to do things like this, and usually companies have gone to the courts, and the courts have not been kind about retroactive, this kind of retroactive norm. But if it works out, I mean, it could take, it could have a 19% impact on bank earnings, according to some of the analysts we spoke to. So it's a very big deal and definitely a surprise.
A 19% impact potentially on bank earnings. That is, as you say, of course, significant. Why were investors taken by surprise around this policy, given the populist nature of this government?
I think because part of the government, I mean, there's two things. One, the government has so far been pretty reasonable. They've been very careful not to upset markets. And indeed, things like spreads, which is a big indication of how the government is doing from an economic point of view, have been very low compared to the past. And the other thing is because the minister, Giancarlo Giorgetti, and also his party are very friendly towards the companies. There's that part of the right wing which is capitalistic and company friendly. So they were hoping they would, sort of take charge of the economic stuff. Something has happened inside the government. We're looking into it. It's pretty clear that at least in this case, Salvini got what he wanted. He's been tweeting it on social media, all along. And he said that this will give the government an extra $2 billion in income, so he's really making it a political move for his electorate. So we'll have to see, however, if it actually, really happens and how much of it is really, really going to impact the banks.
Really interesting in terms of the politics behind this surprise decision. Thank you. Bloomberg's Alessandra Migliaccio in Rome on that surprise tax increase, of course, for Italian lenders. European stocks pairing some of their heavy losses flat now. US futures down 0.2%. That is it for markets today. You can get insights from us in the front of the team on the front page of the Bloomberg website. Stay with us. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Business Week Radio. Live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Italian banks slide, dragging down the sector after the Meloni government plans a surprise tax on profits. Moody's lowers credit ratings for 10 regional U.S. banks and says it may downgrade major lenders. Plus, China's exports fall for a third straight month on slower global demand, while imports plunge in a new blow to the nation's economic recovery. So let's take a look at the European markets map. A lot going on. There's definitely a risk-off mood for two things. They worry about China. There's also a couple of things going on that I guess are short sellers that are worried about what's happening with Country Garden. So look out for stocks and bonds plunging. Country Garden in China. The other stories, of course, what's happening in Italy with the banks. So a couple of things going on. We also have the ECB. I don't know whether we have that figure yet, but consumers seeing inflation at 2.3% in 3 years versus 2.5%. So that's actually some pretty encouraging news from the ECB, certainly expectations from consumers. I don't know whether that then changes their behavior and whether that actually changes in how they spend, and so the trajectory of inflation. Euro dollar, you can see for the moment 109.77, but the big story is, of course, Italian banks. And the cabinet of Giorgia Meloni, the prime minister, approved a surprise tax on banks' extra profits this year to fund tax cuts, but also to support first-time mortgage borrowers. So let's look at what Italian banks are doing. You can see most of them really getting slammed. Intesa Sanpaolo down 6%, UniCredit down 5%. If you look at what these banks have been doing year to date, they're some of the best performers, certainly in Europe. And what's interesting about this package is that we understand by digging around that not a lot of cabinet ministers even knew about it, and it was slipped into a package of other measures, including the grant, for example, of additional taxi licenses. So it's definitely coming as a surprise, not only for people in Italy, but also really for the market as a whole, which is why we're seeing extra pressure across the board. A risk-off mood may be led by that. So this is year-to-date performance for the Italian banks, and today they're getting slammed. Let's also have a look at the week that we've had so far, the picture, and I think it's really all about the 10-year yield because we're also getting a big issuance in the next couple of days. The U.S. 10-year 4.0140, and you can see in the last week the European stocks down 1.6%. So as we've been saying, Italy's cabinet had approved a surprise tax on the extra profits of banks this year. Now, the levy, which reportedly could bring in over 2 billion euros, was slipped into a package of other measures ranging from taxi licenses to foreign investments. Now, joining us now is Bloomberg's Tommaso Ebhardt and Stefania Bianchi to look at the U.S. banks as well. So, Tommaso, first of all, thank you both for joining us. Tommaso, a lot of people are saying, like, what is happening? We weren't really given a heads up. If you're a market participant, we understand that maybe not all cabinet ministers were 100% consulted on this. How much of a surprise is this tax on extra profit for Italian banks?
Francine, buongiorno. It came completely out of the blue. Last cabinet before the summer breaks, Rome is essentially empty, Milan too. Late evening, Salvini came out at the press conference discussing some new norms that were supposed to include more taxi licenses, a norm to protect Italian tech companies, also new rules for how to pay when you go to the beach this summer. And then in the middle of the press conference, Salvini say, oh, by the way, we are adding an extra a tax on the bank's extra profit. So this was announced late Monday. The decree itself doesn't exist, the text of the decree. So we don't know exactly what we are talking about. Analysts are estimating this could cost about 2 billion euros to Italian banks. The market has already lost 10 billion euros this morning.
Yeah, and Tommaso, I know you and I did an interview with the finance minister in Milan a couple of months ago, and we were talking about whether there was something in the cards, and at the time he says probably, quite unlikely, or the market wasn't expecting it. So politically, is it because the Prime Minister feels she needs to give it to, give in to Salvini, or politically, what does it mean for also future decisions going forward?
Yeah, that's quite interesting. First of all, Giorgia Meloni didn't attend the press conference, didn't present this tax. We know that Meloni has tried for several months to reassure market that she's a pro-investor and her government is pro-investor. And then this came completely out of the blue. How I can read it a little bit is the sort of the more populist stance of the government. Salvini said that this is a way to give back money to taxpayers and to help people who are facing difficulties because of the cost of living and the higher mortgages. So the money will be used to finance aids for families.
So we have quite a lot of banking news going on, right? This is the biggest one with Italian banks. But Stefania, we also had Moody's actually concerned about several regional banks in the U.S. Is it new things that they're concerned about, or is it, again, regulation? Is it, the strength of the economy and things that we already know about that they were worried?
Well, Moody's said this was part of a swooping look at mounting pressures on the industry. Obviously, earlier this year, we had the collapse of some regional banks, so this could be part of a follow-on to that. What they say is that they're concerned about higher funding costs and also potential regulatory capital weaknesses, and particularly rising risks for issues concerned with commercial real estate loans. So obviously we all know there's less demand for office space, so there's less demand for perhaps these loans are more risky, and all of these issues could erode potentially their profitability. So really, there could be more bad news for when the US markets open and for US banks. Let's see what happens to their shares.
Yeah, Stefania, we've also seen some changes at UBS. I mean, are we going to see more changes up until we have those earnings on August 31st? How big a news could we get by then?
Yeah. So what we've seen a memo that includes about 40 appointments, some of them, about 6 of them from Credit Suisse for fairly senior roles, the global head of coverage and the global chief of staff, both of them coming from Credit Suisse. What we know is that UBS has already talked about downsizing Credit Suisse's, what they took on from the investment bank there. We're expecting to get more details when UBS come with their second quarter results. That's on August the 31st. So really, I think there will be a lot more details then. But already we're getting glimpses of what could happen there and what shape this bank from the bigger bank that UBS is going to create, what that will look like.
All right, thank you both, Stefania and Tommy. Stefania Bianchi in Dubai, Tommaso Ebhart in Milan for joining us. A big day for banks. Now, joining us for a look at markets is JP Morgan Asset Management Head of Global Multi-Asset Strategy, John Bilton. Every time John comes on, there's a market event, and today it's the banks. The Italian banks are really kind of freaking out the markets because this was unexpected, it was unannounced, it was kind of put in a set of measures that, with taxi licenses. Yeah. Are you worried about what this means?
Look, it's August. There's always bizarre announcements, markets are thin, and of course, you get these big reactions. Is this a helpful move for Italy generally? Probably not, no. We'd be watching more what the BTP to Bund spread does from this, but the banks, let's look at them. This year, with Europe raising rates out of the trap of negative real interest rates, which really hurt bank profits, has certainly boosted the sector, but it's still a relatively cheap sector on a global basis. Is this a negative piece of news? Certainly. But does it really sort of remove the support we've seen for banks generally in the European context? We don't think so. It's worth noting this is a tax on profits. Roll back a few years, exactly, and the banks had no profits. So this is a different story, really.
John, this leads me to my big number. So we've started doing this thing where we choose a big number every day. And today, of course, it had to be linked to Italian banks for John Bilton. It's 2 billion euros. That's a possible state revenue from the surprise Italian bank tax. Now, again, because it's taken everyone by surprise, we don't know whether it's 2 billion, 3 billion. So do you think it's quite, it's quite minimal, or are you invested in banks? I feel like they're getting a lot of political pressure, actually, on all sides, from either changing their model to give back because of higher interest rates, or they're coming once again in the firing line.
Well, as you know, we invest more at the country and regional level, but of course the financial sector is a major piece in so many regions. And one of the reasons for thinking structurally Europe looks like an interesting place to be, the banks are much cleaner. They're able to earn decent revenues, decent profits from the higher interest rate outlook. They've been stress tested to within an inch of their lives. And frankly, Europe actually has a very nicely balanced index. However, we've got a little bit of weakness coming through in data. German factory orders yesterday, pretty disappointing. The data from China today, again, showing that the global goods cycle isn't really getting going as we'd like to see. So we're having to pause a little bit on Europe just now and actually look elsewhere. Look to the US. The large banks have done very well, obviously, and we've just seen a little bit of a shot across the bows to remember, inverted yield curves don't help those regional banks. So that story hasn't gone away, but the economy's doing all right, and so generally we feel comfortable to have some exposure to those markets.
John, does this impact actually the spread between Italian and German yields?
Well, I think what it does is it asks a question about the motivations of the Italian economic policy, and that, of course, is going to give investors some pause for thought when it comes to pricing Italian credit risk versus German credit risk. It's going to be a few days to see how the market chooses to discount that, though.
John, thank you so much. And of course, also a reminder, in the last 10 minutes, we had consumer expectations for euro area inflation actually falling in June. They did remain above the ECB's target of 2%, but it's better news because they fell further in June. We'll be back with JP Morgan Asset Management's John Bilton. Now, coming up, signs of more stress in China's property sector as shares fall in another of the country's major developers. We'll bring you more details on that next, and this is Bloomberg.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. Even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited, finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Welcome back, everyone. Stocks and bonds in Country Garden have plunged after Reuters reported the Chinese property developer said it missed payment on $2 bonds due August 6. Now, the company and its property management arm are now the most shorted members of the Hang Seng Index, following a string of debt defaults in China's property sector. So let's bring in Bloomberg's Rebecca Chung-Wilkins in Hong Kong. Rebecca, this feels to me like a huge deal, right? There's a lot of concern over Country Garden and what this means for investors if it defaults on some payments.
Yeah, absolutely. And that's really in part because Country Garden, when I first started reporting on 3 years ago, was an investment grade name, unlike many of its junk rated peers, at the time the second largest developer in China. And it still today is considered a proxy for contagion. Now, the issue that's really moving the assets this afternoon in Asian trading is this report from Reuters that Country Garden has said apparently that it's going to delay mispayment the date for 2 coupons originally due over this weekend, so effectively due Monday. Now, the prospectus for those 2 coupons shows a 30-day grace period. But if Country Garden does indeed have to start using these grace periods in order to make its bond coupon payments, it's certainly a worrisome sign for investors. And it comes off the back of other negative news. Country Garden, for example, had earlier also cancelled a share placement, had warned of a net loss in earnings in the first half of the year too.
But Rebecca, so how does this play into the wider pressures on property sector, right? It's difficult to know whether this is a property sector concern or whether this really spells trouble for the whole economy.
Well, there's 2 issues to that. The first is the extent to which we see a contagion effect if there are serious liquidity issues at Country Garden and if investors really start to consider default scenarios. So that is certainly a risk. Country Garden is still a very big player, once considered to be one of the survivors of the crackdown. It's about the 6th largest by sales in China. But more broadly, we have seen the PBOC, among others, making efforts to try and step in a little bit more quickly to try and ease the property sector. They did, for example, in quite a rare move, make a public announcement about a meeting they'd had with with private firms, including property developers. It named some of those developers, although they're not ones that really are watched for sort of distressed scenarios. But you can see policymakers are keen to, at the very least, portray this message of support for the sector, which is so critical in getting growth up and running again in China.
Rebecca, thank you so much. Bloomberg's Rebecca Chung-Wilkins there in Hong Kong. Now, JP Morgan Asset Management, head of global multi-asset strategy, John Bilton, is still with us. John, it's unclear actually in this kind of environment where there's optimism, overall about the rally and what stocks are doing, but question marks about China, how you play China.
Yeah. I mean, China's interesting because it had an amazing first quarter in growth terms as it came out of the pandemic, but it faded really quickly. And I think there was a lot of hope of significant stimulus. But you get the sense that policymakers in China are really walking a bit of a tightrope here. They don't want to use the blunt instrument of the property market and really create that speculative bubble once again. But at the same time, as your reporter mentioned, it's a very crucial sector to China, and it's very crucial both for investor confidence, but I think also consumer confidence within the country. And what we're seeing, and I think it came through the trade data, that lack of import growth, in fact, a much worse number than expected, negative 12.4%. Actually, it suggests that China is still really just barely limping along, I think, in terms of growth at the moment. So, the property sector is a known issue, but it really does present policymakers with a question mark, which is stimulate and risk bubble formation or just really try and reassure markets.
So we have confirmation from, Bloomberg sourcing and reporting that actually bondholders and Country Gardens the holders have yet to get coupons. If this were to be confirmed, how would you take the news?
Well, I mean, I can't speculate on an individual name, and we don't know the details of that. But I think what we'd look at is the property sector as a whole. What does it do? Is it pushes confidence out. I think investors at the moment are discounting Chinese stocks very significantly. If you look at China A, if you look at HSI, they're very cheap indices. Earnings, yes, have been beaten up on those. The earnings expectations have been beaten up on those indices. But at the moment, I think international investors are very reluctant to go back in. So this is actually probably a crucial acid test to see how policymakers choose to respond.
John, what's your overall take on stocks? Because I know, Mark Klanovich has thoughts on actually that we're over-optimistic about where stocks could be headed.
Well, I think, look, let's ask the question. I think the most notable feature of the recession of 2023 is going to be its failure to materialise. If that does indeed prove to be the case, then equities probably grind higher from here. We've had a decent earnings season. The fear that everybody has was that margins were going to get crushed because of higher input costs. In fact, this earnings season in the US has shown margins expanding. So we think that there's resilience. We think the pain trade is probably still drifting a little bit higher. No reason to go out and get overexcited on equities. There's plenty of other places to put money to work. But the idea that stocks are overvalued and due a sudden major correction, we think might be wide of the mark at the moment.
John, thank you so much. JP Morgan Asset Management's John Bilton stays with us. We'll talk earnings with him next. This is Bloomberg.
In 2018, the IPCC did what was called the 1.5 report. What was the difference between what a 2-degree world looked like and what a 1.5-degree world? And the catastrophe to the planet between those two poles led everybody to conclude that actually the job is bigger. We have to go to net zero. And that's a transformation of the global economy on the size and scale that's never occurred in human history. So that's a kind of daunting task, but it's full, I think, also of challenge, opportunity, the chance for innovation, and the chance to have the private sector play a fundamental role in making that change happen.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
This is a picture for Italian banks. Now, it is, or is meant to be, a quiet day in August, a Tuesday. Happy Tuesday, everyone. And then we have this surprise tax on Italian banks again. This is on profits. This was decided at a late-night cabinet meeting. We understand that maybe not all also cabinet ministers were attending that. So some of them themselves were taken by surprise. Now, what we understand, again, because it's a surprise by various calculating forces, is that the government could get in around 2 to 3 billion euros thanks to this tax by year end, and they would redistribute it either to help with first-time mortgage holders or also to support the ones that needed the most. Now, we have a wonderful equity research arm, and they've also just put out a story basically saying that this 2 billion euro Italian bank levy could shave 10% off net income. Now, this is what they've calculated so far, and this is by this proposed extraordinary tax on their extra profits this year. Again, everything's to play because we don't exactly have of the details yet, and we don't know also if these banks will push back and get anything. Now, SoftBank shares closing higher after the group's Vision Fund eked out its first profit in more than a year, driven by the global tech rebound that helped lift the value of some of its investments. Now, the Vision Fund swung to a profit of $426 million in the quarter to June, following a record $30 billion loss in the last fiscal year. Still with us is JP Morgan Asset Management's John Bilton. John, overall, when you look at earnings, and I know, we talked about the Italian banks a lot, we look at SoftBank, and it was much worse than expected. It feels like, I guess, 80% of earnings didn't do too badly, and the one that did worse and really got slammed in terms of share price. What's your take on the earnings season?
Well, I think, it wasn't a big surprise in terms of where the beats and misses came in some regards, particularly between top line and bottom line. There was quite a marked slowing at the top line. We've seen nominal growth come down. Inflation's starting to cool. It's what everybody wanted. So guess what? When nominal growth goes down, it's harder to earn those big bumper top line profits. So it wasn't such a great season at the top line. And firms that missed at the top line really did struggle. But what we saw was actually surprisingly good beats at the earnings line. So actually profits holding up much better than I think some had feared. And so as a result, overall, the earnings season, certainly in the US, was reasonable and reasonably well spread. And I think that what we've seen is really the bottoming of that downgrade cycle that's been running now for getting on for 12 months. We've seen earnings per share expectations for this year coming down from just shy of $250 per share to a little bit below $220, and that feels like a much more reasonable level. So here on in, we think that the earnings expectations at least have probably bottomed.
All right, so thank you so much, John, for joining us today. John Bilton, the JP Morgan Asset Management Head of Global Multi-Asset Strategy, of course, on everything from Italian banks to some of the surprises in the Chinese economy, also looking at earnings. Now, coming up, the ECB says consumer inflation expectations fell further in June, but they remained above the central bank's 2% target. So we'll discuss that next. We'll have a full roundup also on what's happening in China with country garden shares and bonds sinking. As we understand, holders are yet to get some of the coupons.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
So Italian banks slide, dragging down the sector after the Meloni government plans a surprise tax on profits. Moody's lowers credit ratings for 10 regional U.S. banks. It says it may downgrade major lenders, plus China's exports fall for a third straight month on slower global demand, while imports plunge in a new blow to the nation's economic recovery. Well, good morning, everyone. Welcome to The Pulse. I'm Francine Lacqua here in London. So consumer expectations for euro area inflation fell in June. It remained above the ECB's 2% target. That's as officials ponder whether to continue their unprecedented bout of interest rate hikes. Now, joining us now is Bloomberg's David Powell and Justina Lee. So thank you so much for joining us. We have a market expert and we have, of course, our chief European economist as well. David, talk me through about what this actually means for the trajectory for inflation. So if consumers think they'll pay less, is there a feedback loop?
Well, exactly. If the expectations of consumers are lower for inflation, when they go to ask for their salary increases in the following year from their employees, they'll ask for less money. And basically, that's why the ECB is concerned about elevated inflation expectations. They're worried about a spiral whereby people expect higher inflation, and therefore they ask for more money from their employers, and then employers have to raise prices, which raises inflation, and it just ends in a vicious cycle.
And just, what does that, when you look at inflation, this is moving everything, right? Every asset class, every kind of thought about what central banks can do. Is there a point where we think that inflation and even expectations are coming down, but then to get from 4% inflation to 2% is going to be the really painful bit?
Yeah, I think exactly that's what the ECB is struggling with right now. There normally is a bit of a lag effect from monetary tightening coming through. And so you have to think about whether you're eventually going to see those effects, and that's going to be enough to curb inflation. Now, the recent data, and including this survey, has shown that things are moving in the right direction. But at the same time, like you said, it's still above 2%. And also, if you look at market expectations of inflation, those have actually risen lately, which is certainly worrying as well.
Yeah. So, David, what are we getting in September? We're probably, are we going to get a 10th straight increase in the deposit rate, or could there be a pause? And how would the market interpret all of this?
Right. Well, our official call is we'll have one final hike of all the policy rates by 25 basis points, but we recognize that final hike is kind of on a knife edge. It may or may not happen. We still have one more inflation report before the ECB meets again, and that's going to be very important for members of the Governing Council, because as they look around at the economic data, they can see that the balance of risks is clearly shifting, that they do too much. There are several areas of weakness, and they don't want to go overboard. So we think it'll happen, but we realize that depending on what happens between now and then, given the data dependency of the ECB, there's an elevated chance it may not materialize in the end.
Yeah, and Christine Lagarde was really at pains in saying, guys, then it's going to stay longer or higher for longer. Is there a market expectations that then they go lower too quickly, or that we'll stay at these levels for quite some quarters?
Well, something that Lagarde's been trying to emphasize really since Sintra is there will not be any cuts in the near future. So what they want is for those higher interest rates to be priced out in the curve to have their full impact. So that's really what they're focused on now, communicating that message. Obviously, the market is not entirely bought into that in the euro area, particularly as it sees cracks in the economy, which are emerging more and more now.
Yeah, so what are you watching for? The market is kind of on tenterhooks, right again, but it's interesting that the communication language of the ECB is then being replicated in other central banks. What are you watching for as we get into September?
The big data point this week is the U.S. CPI, and there we're kind of looking at a similar trend where the data is going in the right direction, but maybe not quickly enough. And of course, the Fed is grappling with similar pressures. And increasingly people are even thinking about, are we going to get a soft landing, or are we going to get a recession after all?
And I don't know how, it's unclear, right, to see, depending on what Lagarde says in September, how asset classes move, because sometimes it's been counterintuitive and they've gone the other way.
Yeah, right. That's exactly right.
David, when you look at what we're seeing from the banks, and actually a lot of the Italian banks, does that put a pressure on financial stability? Does it widen the spread between Italian and Germany? Is this a problem for the ECB?
I think if anything that is going to concern the ECB about what has happened is the whole point of monetary tightening is to reduce the amount of money in circulation and to lower stimulus. And basically what the Italian government has announced is they're taxing banks in order to fund tax cuts. Yeah. And so if you're trying to reduce the amount of monetary stimulus, but on the other hand, the government is pumping in more fiscal stimulus, to some extent it's undoing some of what the ECB does. And Lagarde and other members of the Governing Council have tried to emphasize that it is time for governments to rein in the fiscal stimulus, particularly the measures that were put in place to combat the energy crisis, because the more governments try to stimulate the economy, the more the ECB has to do to withdraw monetary stimulus.
Yeah, our head of equities actually in the newsroom, Blaise wrote it in saying, you know, if you look at how much it's wiped off Italian banks, it's actually 10 billion euros in value right now because of the new tax. And the new tax, we understand, could have brought in 2 billion euros. So to put that into context, the market price move is quite extraordinary today. Justina, on the Fed, so what did you make of the U.S. jobs report on Friday?
Yeah, I mean, you're kind of getting mixed signals here, right? I think
that's what the market is like. What?
Yeah, I think like sort of a good interpretation of it is like, you know, job creation is still slowing, and so maybe people are simply not posting as many job openings. That's certainly, you know, one interpretation of kind of how you might be able to get disinflation without a recession, maybe. But at the same time, I mean, wage growth is key here to inflation, and that's kind of remained pretty hot.
David, does the ECB, I mean, of course they never say it, but how much do they get influenced by what the Fed's doing?
Well, the ECB, of course, as you say, they're always going to say they're influenced or they're driven by what's going on in the euro. And of course, they are driven by what's not going on in the euro. But they can't ignore
But it's interlinked. Right?
Exactly. They can't ignore what's going on elsewhere. One of the reasons, of course, is because it has an impact on the exchange rate, the inflation differential, the interest rate differential. But of course, they also want to see what their colleagues are doing. The ECB is the second largest central bank in the world, so of course it's going to be looking at the first largest or the largest central bank in the world to see how it's combating conditions which are similar and when it's going to pause, etc. So yes, the ECB driven by what's happening in the euro, but certainly not ignoring what the Fed is doing.
All right, thank you both for joining us. David Powell there from Bloomberg Economics and Justina Lee from the MLive team. Now, coming up, we'll have more on the fallout from the Italian Prime Minister Meloni's surprise new tax on Italian banks. More on that next, and this is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights.
How has that shaped your strategy for the bank?
Is this a new normal? Is this like a catalyst?
Do you think we're in a new phase for dividend policy overall?
That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Season is here.
Another crazy busy week.
There's still a lot of uncertainty. The market knows that there's bad things coming.
Bloomberg breaks the numbers first.
A slew of earnings.
Some breaking earnings.
What did we learn from earnings? I mean, a lot of them beat. Some of them got slammed.
With exclusive expert analysis.
This is a growth story.
Advertisers are pulling back. It certainly will be a headwind.
Good revenue growth across the globe. A record year.
We haven't seen a result like that since a decade.
We're not standing still.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
The conversations that matter, the insights you need. This is a Pulse. I'm Francine Lacqua here in London. Now, shares in some of Italy's biggest lenders firmly in the red after Prime Minister Giorgia Meloni unveiled a new tax on banks. Now, the move could have huge implications for the country's banks. We're now joined by Head of Financials of Federated Hermes Limited, Filippo Maria Aluati. Filippo, as always, thank you so much for joining us. Look, we're looking at the banks. They're slammed. In fact, I think that this new tax wiped some $10 billion from market value of all Italian banks. Like, what's your take on this?
Yeah, it's a bit surprising, and I think that's not the first time, and neither won't be the last time. But yeah, the politician put the short terms, say, fiscal gain in order to, and potentially at the cost of longer term cost of equity for the banking sector. Yeah.
But so if you look at who will be taxed the most, is it unclear at the moment if there are certain banks that would do worse than others?
Yeah, based on essentially the available information, because it's not yet been published in the official gazette. So the most domestic banks, the one that rely mostly on the credit business, they will be impacted the most, like bank like BPER or BAMI or Intesa Sanpaolo, more than, say, UniCredit because of the international footprint, and Mediobanca because it's more into, say, wealth management and more than traditional banking. Yeah.
But so how much do we know? And again, because we're kind of all grappling out, is this extra profit that they would have done in Italy, booked in Italy, or worldwide?
I think it's booked in Italy, and it's the extra profit essentially from 21 to 23, essentially. It's, how much the banks are gained from the ECB tightening policy.
Would this impact dividend policy?
Potentially, yes. I mean, so I think at the margin it impaired the share buybacks and potentially the dividend policy, yeah.
So, Filippo, I mean, do banks have any ability to push back on this?
I don't think so, yeah. I mean, so in theory they could say, okay, you know what, we're going to lend less to the real economy. This, I think, is a possibility. In order to, say, retain more earnings, they could say, yeah, we wanted to grow the book, I don't know, by 5-10 billion RWAs, but we're going to grow less because of this new tax.
So, Filippo, what does it tell us? I don't know how you're looking at it. Are you looking at it through the lens of a lot of European banks just being, politically slammed in other countries in Europe, and this is just symptomatic of that? Could we see other countries? Like, is this a game changer?
I don't know if it's a game changer, but and at least not in the short time, but more in the medium term. And I think government, they're sort of strapped for cash, and they want to finance either a fiscal stimulus or maybe pay for the cost of living crisis. Maybe they can resort to utilities or banks, especially traditional banks. So I would think country maybe like Portugal, Greece, more peripheral country. Yeah.
The Italian government so far has put proposals through and then walked them back when there was either a market reaction or big pushback from Europe. If this is the case, could it be an entry level for actually investors?
Yeah, potentially. There's a big if. They say it's extraordinary. It's only applied to full year 23. But as you know, I mean, politicians, they don't like to take back a tax they introduce. So we'll see whether it's just one 2023 story or in 24 they come up with another similar tax.
So do you think that this could be a buying opportunity, or?
It depends on your outlook for the economy. I think if you think the economy will have, in Europe, will have only a swallow recession, then I think, potentially could be a good entry point, yeah.
So the entire sector is being hit today?
Yes.
Why?
Yeah, because, I mean, so people always react. So the first reaction is always in a straight line. They say, okay, today is Italy, who's going to be tomorrow? Maybe Germany, Greece, or Portugal, yeah?
If you look at the French banks, they've actually been the outstanding lot so far, also in terms of earnings and giving back to shareholders. Will they still stay on top?
Yeah, it's a possibility, but at the same time, I think we're nearing the peak in terms of net interest income. So probably Q3 or in some case Q4 also will be the peak of the cycle. Unless, of course, as the ECB decide they want to do even more and go the extra miles.
So, Filippo, how do you break it down, actually, to tell, if you're an investor today, and a lot of the European banks create a good value, but where do you go? Is it country by country, or is it segment by segment?
I think segment by segment. So you want to have a combination of banks that are universal and then banks that are not too exposed to, for example, single sector, like, for example, mortgages or commercial real estate. And then also you want to look at the organic capitalization of the banks, and these are across the jurisdiction, across the business model. And some banks that actually do have a good track record of accruing the book value and the capital generation.
I mean, it's very difficult if you're a European bank to compete with Wall Street.
It is, yeah.
And so what does that, what does that mean for future growth in business models?
Yeah, well, I mean, so it means that they need to be a bit more niche in some cases, because as we've seen with Barclays, Deutsche, Credit Suisse in the past, it doesn't really, you can't really compete against the money center in America. So be nimble, also grow maybe in Asia or in some part of the market where there is less presence from the American banks.
Yeah, what's your take on I mean, I talk about Swiss banks, but the Swiss bank right now.
Now there is one Swiss bank, and I think also the management will have they will cut off, and I think, it's going to be 2 or 3 years when they will really look into the fabric of Credit Suisse, UBS.
I mean, do UK banks look relatively attractive compared to everything else?
Yeah, I kind of think so, yes. I think actually our view is that UK is not that bad, all considered, and I think if we get some, say, subside in terms of this inflation panic and the BOE near its job, then I think also they could potentially, we could see a pop higher for the UK banks.
Filippo, overnight we also had news that Moody's, I think, downgraded some of the smaller to medium-sized US banks. The reasons they gave are things that you and I talk about on a weekly basis. But if they start touching the bigger banks, does it actually make a difference to your investment strategy?
The top 6, potentially. If they touch the top 6, yes, but I don't think so. I think in the medium term is very unlikely. I mean, those banks that touch, I mean, there's also all in all is a relatively mild ratings downgrade. It's nothing like 2 notches or 3 notches. I think essentially it goes back to the ALM mismatch, which is more pronounced in America than in Europe, and then the fact that deposit beta are much higher in America than in Europe. But as always, the rating agency, we may be past the peak in terms of deposit beta. So they act now, but probably they referred to 3 months ago.
All right, Filippo, thank you so much. Filippo Maria Aluati, their head of financials at Federated Hermes Limited. Now, coming up, TSMC is expected to approve the construction of a factory in Germany. We'll bring you the details next, and this is Bloomberg.
watching and says, I want to be Ari Emanuel when I grow up, what should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this, you got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think the biggest opportunity is that Japan is steadily becoming a cashless society. While the adoption rate is still low compared to other countries, it means significant future growth is possible. I believe refining our service will lead to even greater revenues. The challenge, on the other hand, is concerns for security. During the pandemic, many people got comfortable with shopping on e-commerce sites. But when it comes to digital banking, we're hearing questions of security and safety from many of our customers. Our job is to resolve customers' concerns by carefully explaining the safety and reliability of our services. It's not an easy task, and it is a great challenge, but promises a great opportunity.
Speaking of opportunities, so what do you think of the BOJ's policies, in the future, especially the end of negative interest rate policy? Would you think that's going to help your business, push up your profits?
The majority of our assets have floating interest rates, probably the highest proportion among Japanese banks. What does this mean for us? Most of our interest rate income will increase in tandem with the rise in short-term interest. The decision is up to the Bank of Japan, but we believe the end of negative interest rates is a huge chance for us and would result in a significant increase in profits.
So what about tweaks to YCC? Does that impact your business or profits? YCC については、いわゆる長期金利が、今後
We believe the tweak to the yield curve control will have a positive impact on our revenues and profits. First, we can switch to a higher rate when a fixed rate asset reaches its maturity. Secondly, a fairly rapid pace of increase in our deposits means an incremental boost to our assets under management. That incremental part allows us to enjoy the positive impacts of rising long-term interest rates, maybe even more so than other banks.
The chief executive of Japanese lender, their Rakuten Bank, is speaking exclusively to Bloomberg. Now, the Tesla CFO, Zachary Kirkhorn, has stepped down after 13 years at the EV maker. This is a surprise shakeup that, of course, raises questions about succession in the top ranks of Elon Musk's company. Now, Kirkhorn will be continuing to serve in an unspecified capacity through the end of the year to, quote, support a seamless transition. And also, Bloomberg is told that TSMC's board is expected to sign off today on the construction of one factory in the German city of Dresden worth 10 billion euros. Bloomberg's Oliver Kirk now joins us with the very latest. So, Ollie, good morning. Take us through this potential deal.
Yeah, so $10 billion, or 10 billion euros, I should say, as you mentioned there, and about half of that is going to be in subsidies from the German government. So we've had a number of deals, but this is the largest proportion that the German government has put up for this, and this is all to create chips in order to service You guessed it, the auto industry. And this is both to safeguard the future of this industry, where Germany is sort of in a difficult time now and thinking about where the catalysts of growth are going to come from. And so for them, this is really a sort of golden, medallion here. TSMC is seen as a sort of golden standard for the chip industry, and it's going to Dresden, where in Saxony, Silicon Saxony, where a third of all chips in Europe are being built. So it's important to have that sort of ecosystem there with a lot of partners. We understand this deal could also include partnerships with some local chip producers, including Infineon and some others.
So, Ali, a huge push from the German government to own the chip sector. Is it actually going to work?
So this is the big question. Here's why it needs to work. So, just from the de-risking perspective, if there's anything that were to happen with China to not have the supply of chips in the future is a huge threat to the old industry of Germany, the auto sector. But then the question is, since they're behind on EVs, where is the catalyst for growth going to come from? So they've put aside this 200 billion euros, and that is going to go for climate transition, but also for chips. And as you can see there on the screen, 1 billion has already gone to Infineon, up to 5 billion here for TSMC, and 10 billion has gone to Intel. The question is, and this is the question everywhere, will they have the labor to do it? The German workforce is losing 400,000 workers a year in terms of skilled labor every single year. They're up to 7 million people short in the skilled labor economy by 2035. And so the question is, are they going to be able to attract all that skilled labor? Remember, TSMC pushed back their production of chips in Arizona to 2025, saying we just don't have the labor.
Ollie, thanks so much. It's a great point. Oliver Crook there for us in Berlin. Now, let's also get back to our main top story, which is Italian banks today. The government has shocked markets with this unexpected tax on banks' windfall profits, really sending the country's leading lenders down in trading. You can see Intesa Sanpaolo down 7%, Unicredit down 6%. We understand that the administration in Italy is looking for a cheap way to finance help for families hit by the cost of living crisis, including tax cuts and support for mortgage for first-time owners. However, the move also requires approval by Parliament, so it could be changed. If you look at some of the similar measures in other countries in Europe, like Spain, that was definitely challenged. The Deputy Prime Minister, Matteo Salvini, announced this 40% levy on the extra profits of lenders for 2023 late last night. Up next, Bloomberg Surveillance Early Edition with Kriti Gupta in New York and Danny Berger in London, and this is Bloomberg.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund just typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
Top-end venture is sort of 3x net of fees. Ideally, you're hoping for more than that. You're hoping for 5x or more. You're illiquid the entire time, right? So you would hope to get paid for the liquidity.
And today...
So yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie? What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Nugent Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
On the next episode of The Circuit.
I was like, this is a way to change culture. Like, what a different world. Of course, we know for girls, it means so much to have female athletes to look up to, but for boys, to look up to women also, it's really for everyone.
Watch The Circuit with Emily Chang, Thursdays, 10 p.m. Eastern on Bloomberg Television, or 8 p.m. Eastern on Bloomberg.com or the Bloomberg app on connected TVs.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
This is Bloomberg Surveillance Early Edition with Danny Berger and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Moody's lowers credit ratings for 10 regional U.S. banks and says it may downgrade major lenders. Meanwhile, lenders in Italy slump as Meloni's government approves a tax on extra profits of banks this year. And China's exports fall for a third straight month, thanks to slower global demand, while imports plunge in a new blow to the nation's economic recovery. Welcome to Bloomberg Surveillance. You're watching the Early Edition. I'm Danny Berger in London. Kriti Gupta is in New York. Kriti, I mean, we don't love the words U.S. bank and sell-off together, but that's what we're getting. But hey, finally, bonds acting as something of a haven for your portfolio today.
Yeah, perhaps a little bit of a reverting back to some sense of normal, but then again, you don't want downgrade in that vocabulary either, and that's exactly what you're getting coming out of Moody's. This time not on a country basis like you did from Fitch Ratings, of course, last week, but from a regional bank's perspective. Is that banking turmoil that we saw a couple months ago rearing its ugly head again? Well, the futures seem to think so, down about 0.3% already in pre-market trading. We're seeing some pretty broad losses, not seeing much of a bid into any individual stocks or the index broadly, 45.24 on those S&P futures. But Danny, to your point, seeing a bid into the Treasury market, perhaps pairing some of the moves that we have seen kind of in the opposite direction in the last couple of sessions. What's interesting to me, though, is if you look at the front end of the curve, you're not seeing much change in the U.S. bond market. Look at further out, and the 10-year yield, that's where the volatility is to the downside, I suppose, when it comes to yields. Down already 7 basis points this morning, 4.02 we'll call it, on the 10-year yield. But look, a lot of this is coming from what happened overnight in Asia. You saw a massive sell-off in China off that data you were just talking about, Danny. The Hang Seng Index down 1.8%, the regional underperformer in the Asia-Pacific Index. And at the same time, getting some weak employment data and wage data coming out of Japan as well. That's creating weakness in the Japanese yen and Japanese assets broadly, giving a little bit of a tailwind to the dollar this morning, stronger by about 0.4%. The currency pair there, 143.06, Danny.
It really feels like a morning where the hits keep coming. In the futures market trade, which unfortunately I was awake for around 2 a.m. London time, when that Moody's downgrade came out, you did see futures turn. You did see them start to selling off. That continued into the European session, and then we started to digest the Italy news that they would be taxing windfall profits. We're going to get more into that in just a moment with our reporter. So in terms of what's leading European equities down, it's the FTSE MIB. It is Italy. This is all Italian banks here falling by more than 1.5%. A Goldman Sachs index of Italian banks is now on track for its worst day since March, since the SVB blow-up. That's the kind of levels we're looking at for Italian stocks. Meanwhile, that flight into duration, Kriti, you noted in the U.S., it's happening in Germany, too. It's happening throughout Europe. The long end of the curve is getting a sizable bid. And at the moment, German 30-year yields are dropping 11 basis points, just but it's off the back of yesterday. This huge sell-off that took years at one point in Germany in the 30-year, touching their highest since 2014. So we are getting a little bit of the opposite of that. It's a little bit of the banking nerves. And Kriti, just worth mentioning, about an hour or so ago, we got an ECB consumer survey that did revise down inflation expectations. So all of those feeding in to stocks selling off and bonds being bought.
Yeah, a lot of things going on right now, both the European and the American markets. We're going to walk you through it, but let's start with the big story this morning in banking news. Moody's cutting the credit ratings for 10 small and mid-sized U.S. banks, also signaling potential for more downgrades when it comes to the major banks. Joining us now to walk us through it, Bloomberg's Leo Kane-Sherper has all of the details. Leo, what do we need to know here?
Yes, so Moody's has basically given 3 reasons for this rating action. First of all, higher funding costs. As you know, customers are switching to higher yielding deposits, and that drives up costs for banks, the cost that banks pay on these deposits. Second of all, higher capital requirements that were proposed by regulators last month, and Moody's basically said some banks might struggle with that. And then finally, Moody's also flagged lending exposure to old offices. You know, this has been discussed many times before, but now Moody's has taken a rating action based on that risk. And I think it's quite interesting to see we had some high-profile analysts scrapping their recession calls for the US recently, and this move just shows you how fragile the overall environment is.
Yeah, it's not great for corporate bonds. It's not great on a week. We're also going to get bond auctions too. Look, at the same time here in Europe, banks are selling off, specifically Italy, if I can find my words. We had the government approving this windfall tax. How big of a surprise was this?
Yeah, so it was the first thing I saw on my phone this morning, and it definitely took me by surprise. UniCredit and Tesla shares have plunged about 7% this morning, so I think that shows you how much of a shock this was for the wider market. And we have to wait and see if Italy remains an outlier here, but I think it's worth mentioning. In the run-up to second quarter earnings, we had a big debate in the UK with some Labour MPs also bringing up the idea of raising windfall tax further. So I think Italy's move today has definitely kept that debate going.
Yeah, a lot to digest here. And of course, to Danny's point earlier, you're already seeing such a massive market move in those Italian banks. Bloomberg's Leo Kane-Sherper all over our banking stories for us. Over in Asia, China's recovery shows more signs of weakness. Exports plunging over 14% in July from a year earlier. That does mark the worst decline since February of 2020. For more, let's bring in Bloomberg's Justina Lee. Look, Justina, we knew the Chinese economy was slowing. We knew the exports were slowing. Why do we care about this now?
Yeah, I think it really underscores the magnitude of the challenges that China is grappling with here. Because on one hand, you have slowing global demand, which kind of drove that plunge in exports. But at the same time, I mean, a longstanding concern among economists this year has been the weakness in consumer demand internally in China, even after the COVID reopening. And I think the falling imports number points to that. At the same time, we also got news today that a property developer called Country Garden might be missing bond payments. And I think that also points to the challenges in the property market there.
And how is that feeding into what we're seeing in the overall market, the trade today, Justina? Because already, I mean, it was a tough one with some of the banking news we were talking about.
Yeah, exactly. I mean, we're kind of seeing a classic flight to safety day here in markets, and especially true of kind of like Hong Kong and Chinese stock markets today. We have seen shares falling. And I think at the same time, one interesting thing is like China also weakened the fixing around which their currency can fluctuate. So that might be a sign that they're also going to tolerate some softness in the yuan, and that's one reason why the dollar is also trading higher today.
Okay, Justina, thank you very much for that. Justina Lee from our Bloomberg Markets team. Now, elsewhere in earnings, SoftBank shares closed higher after the group's Vision Fund eked out its first profit in more than a year, driven by the global tech rebound that helped lift the valuations of some of its investments. Joining us now is Bloomberg's Tom McKenzie. Tom, I mean, redemption for the Vision Fund. What were some of the numbers here?
Redemption, at least for now, yeah. And part of that obviously helped by the fact that markets are becoming a little less concerned about the higher interest rate environment, and also the hype around AI and the technology gains that we've seen year to date have obviously helped the portfolio of businesses that SoftBank has invested in. So they've posted a profit for the first time in a long time. The Vision Fund of around $425 million US. That's helped reduce the net losses across the group broadly. The paper losses for SoftBank backing companies like Alibaba, Deutsche Telekom, and T-Mobile as well. Interesting, we've been hearing from the CFO on the earnings call, talking to analyst investors and saying, we are now ready to be a little bit more aggressive in terms of investments, potentially saying and describing the position as being defensive and offensive. They've talked about the fact that they've pulled back on some of their Chinese investments and that they have about $8 billion in capital to spend on future investors. So they're getting a little bit more positive about the opportunities, particularly, they say, around value in artificial intelligence and potential growth there. A lot of this, though, the spending power, will also depend on what happens with ARM, of course, in their IPO.
Yeah, and now that you mentioned that, let's go there. You perhaps are seeing some good news when it comes to the SoftBank story, but perhaps some losses when it comes to ARM ahead of that planned IPO. Tom, why does this matter? Walk us through the details.
Yeah, the chip designer, of course, that SoftBank hopes to IPO potentially as soon as September. As you say, coming out with a loss for the most recent quarter, $66 million. Look, Kriti, this won't come as a big surprise to you that the reason for this is the inventory buildup in semiconductors. ARM, of course, is very exposed to consumer products. So think, of course, of the chips that go into smartphones from Samsung to iPhone. And we see there has been, of course, a slowdown in terms of the demand, the sales of smartphones. So that's proving a drag for ARM. The hope for SoftBank and other investors, of course, in ARM is that the AI story will come to fruition, that some of the products that they're designing around AI will end up driving revenues and profits going forward, even as that demand for smartphones starts to slow. On the IPO, we're still waiting for more details on that. We don't have a date yet. They're hoping to raise about $10 billion, and that would give ARM potentially a valuation of between $60 to $70 billion.
Tom, what a treat to have you on the show. Thank you so much for joining. Tom McKenzie there with the latest in the tech world. All right, coming up, we're going to talk more about earnings. This one is a major blow. It was for Glencore. The firm's half-year profit plunged 50% amid easing in commodity prices. We're going to discuss that next. And J.P. Morgan's Marko Kolanovic not willing to throw in the bear's towel yet. He says a soft landing is, quote, far-fetched, just after the firm's economists scrapped their recession call. We're going to have more on that next. Plus, we're going to catch up with Kevin Gordon, Senior Investment Strategist at Charles Schwab later this hour. This is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London with Kriti Gupta in New York. Now, Glencore has reported its half-year profit, and it fell more than 50%, but disappointing Chinese demand weighing on commodity prices. Liza Hill, Bloomberg Metals and Mining Editor, joins us now. Liza, what do you make of this profit drop? Because it's something we've seen from some of the other commodity giants. What did you make of Glencore specifically?
Yeah, that's exactly it. So on Glencore's side, we saw them flagging a drop in coal prices. Cobalt was another thing. Like the other miners that we've seen, Rio Tinto, Anglo American, they also had some inflationary pressures, pushing up costs at the mines around the world. And then Glencore in particular has this massive trading business, which, like the other traders, Trafigura, Vitol, just saw these absolutely eye-watering profits last year when we saw energy prices spiking and swinging so sharply. And basically the message from Glencore, and that we've seen flagged from some of the other traders, is that life is getting back to normal. They're still making quite a lot of money, but those kind of crazy profits are probably over for now.
Yeah, that 50% drop isn't exactly a encouraging number, but at the same time, they're dealing with that takeover fight with Teck Resources. What is the latest there?
Yeah, so not too many more details. The latest twist that we had in this fight, if you remember, in February, Teck announced that it rejected a takeover offer from Glencore. They kind of went back and forth. There was a bit of drama. And then in June, the latest twist was that Glencore announced it had made a bid just for Teck's coal business. So we understand it's offered around $8 billion just to buy Teck's coal business. And the plan is to put Teck's steelmaking coal assets with Glencore's thermal coal assets and then eventually spin that out into a new company. So the message from Glencore today is they're still very interested in doing that deal. And one of the ways they've signaled that is they've actually withheld $2 billion that they would have ordinarily returned to shareholders in dividends as kind of a war chest in the hopes that that Teck coal deal is successful.
Certainly a lot to digest. Liza Hill, thank you as always for walking us through a crucial story. It really does have ramifications around the world. Another major earnings story we're watching is Bayer. Shares are falling after the firm cut its sales forecast for its crop science and pharma divisions. Bayer writes in a statement, quote, crop science registered a significant decrease in sales that was mainly due to lower volumes and prices for glyphosate-based products. Based on the current development, we have lowered our outlook for full year of 2023. Let's bring in Bloomberg's Tim Lowe for a little bit more information. Tim, look, on the surface, these forecast cuts aren't exactly good news. Is there any good news from the earnings report?
Well, there perhaps a couple of rays of hope. Within the crop science division, there's the herbicides, which is glyphosate-driven, Roundup, etc. That's been crushed this year. The glyphosate prices have just been really bad. The seeds business, which is really where a lot of the intellectual property is and genetically modifying, the corn has been going up. That's good. Soybeans, not so much. It's been kind of a mixed bag around the world. A lot of bad weather in the planting seasons and whatnot. Long term, if you look at glyphosate prices, the ticker we have on the terminal, it's gone up a little bit in the last couple of weeks. It's still got a long ways to go, though, if it's going to be a source of real growth for Bayer as it was in the last couple of years.
Tim, what about the overall sort of drug division? We've talked a lot about the crops and the impact there. What did we make of Bayer's results in that regard?
Yeah, on the drug side, Bayer has a pretty fundamental problem coming in the next few years. The two big blockbusters of recent years, Xarelto and Eylea, are both starting to face a lot more competition. They have some new drugs, a cancer drug. They're growing fast, but at best, in the near term, it's going to be kind of a flat picture for the pharmaceutical sales. The big question is, how are they going to fund future growth there? And that's where the bigger picture questions start coming in about the whole conglomerate setup of Bayer and whether it makes sense. You have a new CEO, Bill Anderson, who came in June. He's a classically a pharma guy. He was at Roche for years. And, investors are just kind of parsing every word he says at this point to try to gauge what he views as the long-term approach. He's been so far keeping his cards close to his chest, talking a lot about eking out incremental improvements at the company by, improving the culture, being a bit more innovative. But that's going to take some time to really move the needle, I think. So it's a lot of questions still swirling.
Tim, while we got you, I got to say, one of the things I'm most interested in hearing about this earnings season are what some of these pharma companies have to say about their weight loss drug. Novo Nordisk, which has Wegovy, is going to be reporting later this week. I think we're either getting Eli Lilly today or we got them yesterday. How big of a boon is this to the pharma industry, some of these weight loss drugs that we're hearing about?
Well, I mean, you're here talking about, these could be some of the biggest drugs of all time in terms of money and demand. It kind of remains to be seen. The global picture for demand, obesity, etc. It's a pretty clear and not particularly rosy picture. So that suggests that there's a lot of need globally to handle obesity, to handle the effects of obesity. These drugs are coming in and they're growing like crazy, but they're still really new, and there's a lot of questions about whether people can take them indefinitely, what some of the side effects might be. So it's almost like the start of a gold rush or something, in a sense. Obviously.
Yeah, the struggle to keep up with demand, I mean, that just kind of tells you where we are. By the way, our very own in-house expert, earnings expert, Kriti Gupta, reliably tells me that Eli Lilly earnings are today. So there's that question answered. Tim, thank you so much for joining us. That's Bloomberg's Tim Lowe. All right, coming up, stay underweight stocks. I swear that wasn't meant to be a pun. I did not know we'd be going from weight loss to this, but stay underweight stocks. That's the view from JP Morgan's Marko Kolanovic as he calls a U.S. soft landing, quote, far-fetched. We'll have more on what he had to say. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
DOJ or other authorities.
Could face bigger challenges next.
Was going to keep rating World Cup. This is a 3.
As the economic picture does. The OK is getting ready to make.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London with Kriti Gupta in New York. All right, so one of Wall Street's current bears isn't throwing in the bearish towel quite yet. It's JP Morgan's Marko Kolanovic. And he has a note out, it hit last night, saying that the idea of an economic soft landing is far-fetched and maintain his recommendation, Kriti, to avoid stocks. So specifically, he said we disagree with the market's expectation that a soft landing is the most likely outcome, also saying central banks are unlikely to ease in the near term, QT will continue, and the base case is for an economic slowdown. It's interesting, Kriti, to see just who is kind of capitulating on their bearish call and who is not, especially within the very own house of JP Morgan.
Yeah, I'm still kind of wrapping my head around kind of this role reversal you've seen across Wall Street on really turning some of their calls. The bulls are now bears and the bears are now bulls. But to your point, there is a little bit of internal infighting, it seems, as well. The chief economist, Michael Feroli, last week had scrapped his call for U.S. recession. He actually wrote, quote, the likelihood of contraction has diminished in recent months. A relatively quick resolution of the debt ceiling has taken one type of financial crisis risk off the table, which is an interesting concept, Danny, simply because the risk of that debt ceiling crisis, yes, it shook markets a little bit, but from a market participant's perspective, they tend to kind of brush that off until the last minute.
They have, and I mean, maybe that's why until really this week and a little bit last week, you've seen equities be able to move higher. And that's why a lot of these bears have had to capitulate. But again, I will say it, even though Mike Wilson kind of said, I got this call wrong, he's still sticking by his call. He was with the surveillance team yesterday, that you need to be more selective, that it's risky out there. Marko Kolanovic, he's not letting go of the call. And look, it is easy to get married to your call, especially if you got it right last year, saying that things would sell off. But if the economists are moving in a certain direction, again, I find this really interesting. They're surely looking at the same stuff that only the economists, it's only this really strategic capitulation that we've seen, not necessarily the strategists.
Yeah, and it really comes down to, it feels like from a economist perspective that you were pointing out, it's really the fundamental story, but there is market plumbing to be thinking about as well. It's not as simple as, well, the economy's growing, so the stock market should grow as well. It's not as easy. If it were, I think we'd be out of a job, Danny. And that's, I think, why you're starting to see Marko Kolanovic pay attention to other things like the balance sheet, like the expansion, and other factors that really go beyond just the success of the economy.
Or we would have a different job. We would try to trade the thing itself, which, you know,
that'll go
think
well.
either of us necessarily want to do. Yeah. Okay, well, there is one call that both JP Morgan and Goldman are currently in agreement with, and that's that last week's sell-off in treasuries. It's gone too far. Goldman specifically saying by duration, by 30 years, the yields had closed near multi-year highs. But that is what we're seeing, Kriti. A lot of things going on in the market today. But perhaps of what we're seeing, this huge rally, lower by 10 basis points for U.S. 30-year yields, is some of that. Some people saying the sell-off last week just went too far.
Yeah, and I mean, this is something you're seeing across Wall Street. A lot of the banks, to your point, really agreeing on this. JP Morgan, Goldman, Morgan Stanley. Let's see if people actually follow those calls right now, Danny, because you are still at the point seeing volatility.
Well, let's see if our next guest agrees with that. We're going to be speaking to Kevin Gordon, Charles Schwab Senior Investment Strategist, next. This is Bloomberg.
Get a degree in finance. Go for a career in tech instead. That's the advice from the latest Bloomberg survey of professional and retail investors. Only 1 in 5 Wall Street professionals say high school seniors graduating this year should follow their footsteps and go into finance. About half say that Gen Z's best bet actually lies in the tech sector, and that's despite all those recent layoffs at companies like Meta, Amazon, and Google. Still, hiring trends paint a rosy picture for those with a background in tech. Industries ranging from auto to the federal government have jumped at the chance to recruit any laid-off tech workers. A degree in tech could set you up for a lot of potential jobs and a safety net if any of those jobs don't quite pan out the way that you'd hoped. Survey respondents also expressed concern about the long-term threat of AI. Think ChatGPT taking all of our jobs. For kids graduating from kindergarten this year, about 40% of investors said to go into healthcare. That way, when they come of age, they may be able to hedge against any potential AI-related job takeovers. Roughly 12% said Wall Street would be the right career given that pending AI threat. The AI concerns come despite traders themselves finding that current iterations of ChatGPT struggle with things like math and corporate earnings. But the idea here is that there's still plenty of time for AI to improve and to potentially threaten our jobs along the way.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Moody's lowers credit ratings for 10 regional U.S. banks and says it could downgrade major lenders as well. Meanwhile, over in Italy, lenders slump as Meloni's government approves a tax on the extra profits of banks this year. Meanwhile, in China, exports fall for a third straight month thanks to slower global demand. Imports, on the other hand, plunging in a new blow to the nation's economic recovery. I'm Kriti Gupta in New York with Danny Berger in London. Danny, there's a lot of cross currents here. The banking crisis now suddenly back in focus and moving markets.
Yeah, I thought we were done with this. We're not done. We're never done. I mean, even though we have seen some U.S. banks sell off some of their loan book, that's not enough to satisfy Moody's. I'll tell you, the ratings agencies are really out for blood these days. Last week, it was about U.S. sovereign debt. Again, this week, just U.S. banks. And to make matters worse, we also had the surprise news overnight that Italy is approving a windfall tax to the region's lenders. So in the European session, overall equities are down, but they're led lower by the FTSE MIB and by Italian banks. The FTSE MIB down more than 2%. All of those kind of worrisome developments, what that means for the American corporate bond market, the bond market in general, for banks, is sending a bid into debt, into government debt. We saw last week a lot of it selling off, so some of that is reversal too. But Kriti, for the moment, Germany 30-year yields are down by 12 basis points. That will be, if it holds, the biggest drop since April of this year.
Yeah, it's interesting what you're seeing in the kind of the duration play here, the 30-year that you point to in Germany, but also stateside, seeing some volatility here as well. Look, when you look at futures trading, you're already seeing a pullback, even on the micro basis, a major sell-off across all sectors, all individual stocks, not a ton of green on the screen, and I think really accelerating in the last 30 minutes or so. You are seeing futures down about 0.5%, 45.17 for our radio audience on those contracts. But Danny, again, back to the bond market, the 10-year yield down 8 basis points. Again, and we're only 30 minutes in to this morning. We're right around that round number. Technicals playing in here, 4% on that 10-year yield. I think what's interesting, though, is what happened overnight, because we talked about this weak data coming out of China on the imports and the export side, taking the Hang Seng Index down about 1.8%, really the underperformer in the entire index, and even seeing some weakness in Japan as well. Surprise, surprise, with weaker wage data and employment data, sending the yen
again down to 143.08 against the dollar. Strength for the greenback higher by 0.4%. There's a lot of cross currents here. We have the perfect guest to break it all down for us. Joining us right here on set, Kevin Gordon, Senior Investment Strategist over at Charles Schwab. Now, Kevin, we're already seeing a little bit of a sell-off. Today's trade makes a lot of sense. But let's zoom out here because we've seen some conflicting calls. We were just talking about these kind of internal divergence over at JP Morgan, where on the one hand, if the economy is recovering, does that mean the stock market will recover as well? Your take?
Well, I think what makes it difficult when you talk about soft landing and kind of the broader soft landing for the entire economy, we haven't been thinking about it that way because our view and our thesis really since the beginning of last year has been we've been suffering from these series of rolling recessions throughout the economy. And so, traditional soft landing to us is sort of off the table because you've had key segments of the economy, housing, the goods sector, parts of manufacturing that have already kind of entered their own recession and actually are starting to show signs of recovery. At the same time now that you're starting to see some cracks develop in services, some cracks develop in labor, which those were the key areas that were kind of holding us up last year, and that was the positive offset. So I think that's what makes kind of the market call and the economic call sort of at times in conflict with each other, because you could see how some parts of the market will struggle definitely from disinflation, even though that might sound counterintuitive, but if you lose pricing power at a time when labor costs are still sticky, that's where I think the dynamic between the market versus the economy is. So it makes the call, really tough, especially when you're trying to gauge out, next, into 2024.
But there's a difference between recovery and resiliency. Which one is it here? Are you net, given the parts of the economy that are succeeding and the parts of the economy that are kind of lagging, net, is it resiliency or recovery?
I think resilience for now. And there's maybe this is just kind of too technical, but I think resilience to me is a bit more of a defensive posture as something, as opposed to an actual recovery that's durable, that's a little bit more aggressive and you're actually moving yourself out of a recession. But again, that's what makes this tough because even within something like housing, you've seen a pretty, incredible recovery in something like new home sales, but existing home sales have still declined. Now you have price pressure that's coming back with, the home price decline itself. Max drawdown, was really nothing terrible when you compare it relative to history. Certainly when you compare it to the housing crisis, which is maybe not a fair comparison. But I think, even within certain segments, you're not really getting, kind of those major drawdowns and major sources of weakness that you would typically see in a recession. So that's what makes part of this just really unique relative to history.
Can we say where we are in this cycle at all at this point, Kevin, or is it just kind of a big question mark?
I think if you're going to base it, really the broader recession call for a lot of people is based around the labor market. So if you want to just use that metric, there are a lot of indicators within labor that still look late cycle. You could look to the cuts to hours worked, the decline in, temporary payrolls, which tend to lead overall payrolls. You can look at sort of the, the quits rate and the pace that's coming down at. And again, there are positive offsets in labor just like there are for the rest of the economy. But I think until you get a stabilization in leading indicators like the ISMs, until you have more of a durable recovery in housing, and then that starts to feed through to the broader labor market, that's when I think you can be a little bit more sure that you're not as late cycle, as some of the indicators would suggest.
Okay, the other confusing thing about this market right now is bonds, because we started this year by saying it was going to be the year of the bond market. That obviously hasn't happened. We're also looking at a sell-off last week to try to digest this new supply that's going to come to market. Kevin, where do bonds sit in a portfolio in terms of hedges? Are they still useful?
Well, our fixed income team has been really pounding the table on this and really trying to, take advantage of, if it makes sense for your portfolio, obviously, as the investor, but if it makes sense to sort of extend duration, kind of take advantage of yields at these levels. Because I think, one of the interesting parts of this cycle where we're at right now, if this is a new kind of durable bull market, even if it's different and kind of weaker relative to history, is just the relationship between stocks and bonds from an earnings yield perspective. So you look at the spread between something even just like the 10-year yield and then what you earn on equities is basically near flat, and you're kind of hovering at a 20-year low. And for a considerable amount of time, especially post-financial crisis expansion and in the secular bull market that we've been in, you've kind of been able to make an argument, even if multiples got stretched, that stocks were relatively more attractive when you compare them to bonds. That's not really the case as much anymore. So it's not that stocks are unattractive, but in our perspective, even within the equity universe, you want to be properly diversified, but you also want to expand that out to broader asset classes, and especially in the bond market, bonds are back and they look pretty attractive. So we've been really pushing for just kind of exploring that to the extent it makes sense for a portfolio.
I want to bring it back to the stock market here because Danny might like bonds. I prefer the stock market. You talked about the labor market specifically. We're seeing a lot of these union contracts really push some of the margins of the biggest companies, not just in the United States, but around the world. Is that an issue? How hard is that to model when you're talking about sticky wages and just how much that's eating into even the bottom line of UPS, which is reporting this morning?
You know, it's hard because unionization rates just in general are just not as high as we've seen. You know, you always hear the comparison back to the 70s and the 80s when we had kind of more, stickier inflation, especially on the wage side. But I think that when you kind of take the broader picture of labor costs themselves, that's kind of, that's an area of inflation that hasn't readjusted as much to the downside. And you're starting to see, nascent signs of it, specifically with the productivity and the unit labor cost data we got last week. There was a lot of cheering about that. Number one, it's revised a lot. Number two, a lot of that was basically just due to cuts to hours worked. So that works great in the near term, and if companies can kind of protect margins that way and protect productivity that way. But if you continue to see, more aggressive cuts to hours worked, and then eventually that leads to layoffs, that's when you get in more of kind of a vicious spiral for the broader economy and the broader labor market. But I think, it's great at grabbing headlines and certainly garners a lot of attention, but when you compare it to the broader kind of unionization relative to when we saw, decades ago, it's not really the same. But I do think, from the Fed's perspective, wanting to bring down any sort of signs of, wage stickiness is still key. They're still much more focused on the upside risk to inflation than they are the downside risk to the economy or what a recession might bring. So I think that's the bigger picture that we have to keep in mind right now.
For this earnings season, we are more than halfway through. Security, I can talk about stocks too. We are more than halfway through the earnings season. Kevin, have you learned anything you didn't already know about the health of corporate America through these results we've gotten so far?
I think it's much more actually the response from the market that hasn't been not terribly surprising, but I think telling in the sense that, one of the first things I look at when I pull up Bloomberg is the data from Bloomberg Intelligence, looking at that spread and sort of the excess return from companies in a stock perspective relative to the broader market when they beat estimates, whether it's sales and earnings or a combination of both. And right now that's basically tracking at flat, meaning there's no outperformance. So there's no edge if you beat estimates. And to us, that means, number one, you were probably fully priced heading into the earnings season. Expectations were pretty solid. The bar wasn't lowered too much. And then number two, I think, rightfully so, the market's probably shifting just more attention to guidance and what companies are guiding for the rest of the year and then into the turn of the year. So to us, that's more of an important development where you start to see, are there more significant cuts to guidance? Has revenue guidance actually started to come down, which I would actually put as more of an emphasis on rather than earnings themselves, because you're now in an environment from a broader macro sense where revenues are contracting, real revenues are contracting. So if that's the case, you have to start looking for companies that can actually outperform in that environment and that are seeing not only strong nominal revenue growth, but strong real revenue growth too.
So revenue growth, labor, Kevin Gordon of Charles Schwab covers it all. We thank you as always for waking up this morning and joining us. And we're going to continue that conversation, especially when it comes to earnings season. UPS reporting in less than an hour. We're going to discuss declining demand, higher expenses, and of course, that major labor deal. All of that next. Stick with us. This is Bloomberg.
Digitize, and so the orders come in and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become
the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Danny Berger in London. UPS set to report its second quarter results at the top of the next hour. Investors will be eager for any details on the new tentative labor agreement struck recently with the Teamsters Union. Lee Klasko, Bloomberg Intelligence Senior Transportation and Logistics Analyst, joins us now. Waking up early. Thank you, as always, for doing that.
My pleasure.
Let's start with the earnings story here.
Sure.
Net, if you're seeing shipping volumes decline all around the world, we just got export data out of China that suggested the same thing. What is the read-through into UPS?
Yeah, so what we're expecting is UPS will have volume down, mid to low single digits. I think that's expected. You're coming off like creamy highs from last year during the pandemic. We're really going through a more normalization. That's actually good and bad. Obviously, low volume is obviously not a great thing because it's a deleveraging an asset-intensive network. But also the mix might actually be slightly improving. You might get more B2B and less B2C. So B2C is your home delivery. That usually comes with lower margins, higher costs. So the mix actually might be improving. But net, we're really not looking at 2Q. We don't really care too much about 2Q because that's in the rearview mirror. You might have heard they had this big labor deal,
rings a bell.
Yeah. So they averted a strike, which is fantastic for UPS and its customers and its employees. But at the end of the day, it comes at higher costs, and UPS will have to kind of mitigate those higher costs. Everyone knew that a new contract was coming. Yeah. I think that the expectation was probably it wasn't going to be as costly as it is. If you do a swag, it might have cost an additional $2 billion over the next 12 months. That's probably anywhere between $500 million to maybe $750 million more than what people were expecting.
Yeah.
And that could just be a drag on margins by up to 100 basis points. So we expect them to guide lower when they report earlier this morning for the full year.
Is that kind of what we're waiting for? Because intuitively, to your point, if you do have that higher wage contract, and by the way, they've set the tone for labor negotiations across the country, across the railroads, across logistics, which of course you cover, if they are arguing for more, and you are seeing that pressure on margins, why are the stocks not taking a bigger hit?
Well, they have pricing power, right? There's really only two major players in the space in the U.S., maybe three globally. And obviously, there's little niche players. There's U.S. Postal Service. There's local postal services around the world that do more local delivery. But in the U.S., if you want to get, a letter from point A to point B that has to get there overnight, you're probably using FedEx or UPS. Or if you're, you order yourself, I don't know, a T-shirt or sneakers, and you need them the next day, you're probably going UPS or FedEx. So they do have pricing power. They are going to be implementing maybe, higher general rate increases next year to kind of compensate for these higher costs. Obviously, the large customers get to discount off that general rate increase. And there's going to be productivity things that they're going to be able to do. They're implementing more and more technology. I don't want to say they're going to be AI players, but, they're probably going to implement...
Carefully.
I know. They're probably going to implement more technology to help kind of just whether it's internally through delivering a package or, on the back office. Yeah. So they're just going to implement more technology.
Hey, Lee, Danny here in London. Thanks for joining us. Look, when it comes to those price increases that they might pass on to the customer, do we have any sign about how much they can push this? It feels like we're in this really unknown space with the consumer at this moment, especially if they're starting to turn away from the goods economy and to the services economy. Even though they have pricing power, is there still a limit to how much they can really push through those higher costs they're facing?
Sure. So maybe for its largest customers, it might be a little harder. But UPS and FedEx are going after kind of the smaller middle market shipper. And those margins tend to be better because they don't have the pricing power that a large retailer might have. Like FedEx and UPS, or FedEx has totally pretty much stepped away from Amazon. UPS is slowly moving away from Amazon because, while that business is decent, it probably comes at a lower margin for UPS.
Now, if we are seeing this, again, this normalization in consumer spending, Lee, does it get back to really where we were pre-COVID? Because a lot of the conversation during COVID from a lot of these shippers from the Amazons of the world saying, look, once the consumer gets used to shipping everything, they're not going to stop. They're going to want to keep up this habit. Is any of that true at all, or are we expecting volumes to just go back to what they were before the pandemic?
No, not in our view. We think this year is a reset. So everything's being recalibrated to a normalization, if you will, from the pandemic. And we expect growth, whether it's revenue, earnings, volume, all next year. UPS will have to pull some levers to offset the costs that they're dealing with this new labor agreement. But we're actually relatively bullish. While people haven't said that there's going to be a fantastic peak season, we do think there's going to be some seasonality going into the fourth quarter, which will be very good. That is also a little bit has to do with easier comparisons because last year was a terrible peak season from a normal seasonality standpoint. So we think there's going to be more seasonality this year. The consumer continues to be resilient. We remain relatively bullish on the macro outlook, even though we have been in a freight recession for quite some time. The consumer still remains strong, and we're expecting a rebound in demand for most freight next year.
One of the, I think, fun facts, my favorite fun facts about UPS is that its largest customer, or one of its largest customers, is Amazon Logistics. But I'm curious, if you're looking at Amazon earnings, I'm gonna get a little nerdy here with you, bear with me. If you're looking at Amazon earnings and they have this kind of long-term shift away from their e-commerce business towards their cloud business, for example, what is the read-through into UPS that depends on them for that business?
Yeah, so I mentioned earlier small to mid-sized businesses. So if UPS can fill the void that Amazon leaves with small to mid-sized businesses, shippers, then it is a win-win for UPS.
Yeah. But they already tried to do that.
They're doing that right now.
Yeah.
It's happening right now. You can hear it.
Yeah.
It's happening right now. And that's what they're doing. And they're going to more profitable verticals like healthcare.
Yeah.
Healthcare, obviously, if you need drugs from point A to point B, it's maybe temperature controlled.
Yeah.
Like during COVID, they had to be the vaccines had to be frozen. So it's more complicated, and with complexity comes margins. So they're focusing on profitable verticals like healthcare. They're focusing on small to mid-sized shippers, and that's not like, oh, UPS is doing something different. FedEx is doing it.
Yeah.
DHL is doing it. They're all doing it because they realize that they want to go after these more profitable businesses, and there is a great market out there that's not Amazon. I mean, Amazon's a fantastic company. They're building a logistics network, and that's really for them just to lower their overall costs.
Right.
But we don't see them as a competitor because as of right now, they're not picking up. They're just delivering.
Yeah, and they have that spillover effect, of course. Lee Klaska all over everything UPS and logistics related. We thank you, as always, for joining the show. He, of course, works for Bloomberg Intelligence. Watch for his analysis as those earnings drop in about 10 minutes. Coming up on the show, a look at some of the market-moving events to watch throughout the day. This is Bloomberg.
So what is the best investment advice anybody's ever given you?
you don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO, so buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
From our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Kriti Gupta is in New York. Let's get you set up now for your trading day and a look at what's ahead. Fed Presidents Patrick Harker and Tom Barkin are both going to be speaking at 8 a.m. Eastern Time. Then we're going to be getting the U.S. wholesale inventories at 10 a.m. And then we're going to get another auction today. The Treasury's 3-year note offering of $42 billion at 1 p.m. And then earnings are going to continue. We're going to get UPS. We're just talking with our Bloomberg Intelligence team about that. Eli Lilly, Lyft, and Rivian all reporting today. Interesting to see what the demand for that Treasury auction will be. But of course, Kriti, the big ones come tomorrow and the next day with a 10 and 30-year auction.
Danny, a lot of things, a lot of cross currents to get through, but I want to say when you're looking at the market here, you are seeing some broad declines, except for this one stock that seems to kind of be defying gravity this morning, and it's Paramount of all companies. PARA for our radio audience is the ticker. It's actually higher by over 3%, 3.4% to be specific, trading about $16.63. This comes after their streaming business actually showing a lot of improvement. Danny, you don't hear that a lot right now, that a part of the media business is doing very well. And speaking of that media business, let's take it to Amazon because they've got their hands in a little bit of everything. Amazon NAS, their Amazon Prime Video, their logistics business, and of course their cloud unit as well. Well, right now the stock is taking a hit about 0.7%. Remember, they're also dealing with a court case with FTC. Lena Khan, of course, has it out for Amazon. Next week, they're going to be pushing in a final last time Hail Mary kind of call to avoid the antitrust lawsuit. We'll, of course, see how it plays out and cover it live for you on Bloomberg Television and radio. And sticking with that big tech trade, let's talk about Tesla replacing their CFO after 13 years at the EV maker. Dan, a succession story in the works. Tesla shares down by 0.8%.
I gotta say, the quote of the day comes from our Bloomberg story on this from Gene Munster, partner at Deepwater, who says he's done a 13-year tour of duty working for Elon, which is like working 50 years for anyone else. Kriti.
That is brutal. I wonder if he'll put that on his resume. Certainly something we're going to be watching and, of course, monitoring the shares as it has a broader readout throughout the rest of the market. Futures down about 22, down about 0.5%. Stick with us. That does it for early edition. Surveillance is ahead. Good morning. This is Bloomberg.
cruise ship is much more than a flotilla of financials and numbers. Naftali Holt showed me around the Celebrity Beyond, Royal Caribbean's newest ship, rolling out not the red carpet, instead, the magic carpet, an example of investment that's yielding returns in several different ways.
Originally, actually, we designed it because we wanted to have a really nice platform for tendering, because sometimes we can't home port
So
destinations.
functional.
Exactly, value fractional. And then we looked at it and said, why don't we just make it a really cool feature spot where people can enjoy it beyond the functional space? And we created this bar. It went up and down.
Now, what does it take to
How
do?
about the Instagram? Can you speak about that?
I can imagine.
Instagram moment with the sunset, you're having a drink with your friends or family. I mean, that's amazing.
So what does it take to do something like this? And I'm thinking cost, engineering, time.
Yeah, a lot of effort from a lot of people. So it starts from just the design and the conceptual aspect of it. Then we need to figure out a lot of technical factors, the weight, the wind, and so lots and lots of hours of really hard work. And every time we up the game, we see that customer willing to spend more.
This is Bloomberg.
Broadly speaking, the economy has been extraordinarily resilient to very high interest rates.
It just feels like this market needs to stop, pause, have a little moment of digestion, and catch its breath.
It seems like we're getting to the end of the Fed tightening cycle.
If we are getting inflation sustainably back to 2%, that has to happen with some kind of contractions.
There are signs that certain parts of the economy are reaccelerating.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Live from New York City this morning. Good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market on the S&P 500 negative by 0.4%. More downgrades a week since the last set of downgrades. This time not on the sovereign, on U.S. banks, Tom. 10 of them. Downgrades from Moody's overnight.
Well, that's a bank story here. There's a bank story in Italy as well. And I guess, that's sort of the economic thing to look at. But overwhelming everything here this morning, led by the news out of China, it is Deflation Tuesday. There's no other way to put it. I'm looking at this screen, John, and I haven't seen that screen in 4, 5, 6 years.
Trade numbers dreadful. Exports, imports, take your pick your region. Dreadful.
We were out front of this story yesterday, and John, I'm going to repeat it again. Instantly, there's deflation in the air. I can bore you with 8 ways to go here. It doesn't matter. Right now, all you got to do is see even oil breaks down.
Every single time we get some data, Lisa, out of China, it's downside surprise, and the trade data, no different.
And this is one interesting area. You can see that the divergence between the U.S. and China has been accelerating. And what you have seen with respect to the U.S. dependence on China is it's decreasing, even though in Europe, it's not. And so, again, I wonder how much those stories are linked. The underperformance of Germany and the outperformance of the United States.
I'm going to bring it right back to where you started, John, is the banks. The banks have to deal with this disinflationary deflation tendency. And I think you're going to see that. You've got some quotes I know this morning here from some of the bankers trying to figure out soft landing or that. But with this deflation overhaul, I wonder what it means, not only for the big banks, but for the SVBs we've all forgotten about.
Mark Oklanovic pushing back over at JP Morgan, as you might expect, against the prospect of a soft landing.
They're all on the same
Pushback
page.
from Moody's. I think Moody's just turning up the volume once again on a conversation we're already having. Higher funding costs of smaller banks in America, potential regulatory capital weakness there as well, and rising risk tied to commercial real estate, Tom. They're all known knowns, aren't they, in many ways? There's nothing new there. But just like Fitch last week, it just turns the volume up a little bit on a conversation people are already having.
To me, this is a bigger deal than Fitch. Fitch, I get, and there was an uproar, and Secretary Yellen and others got all mental about it. This is just, here's where we are. We've had a 2023 of surprise and shock, and all of a sudden there's this global deflationary tendency. Who looks good this morning looking at the launch pads, the IMF with that cautious 5-year view that they gave us months and months ago.
Do you want the look on UPS right now? Revenue $22.1 billion for the second quarter, the estimate 23. So that's a slight downside surprise. EPS for the second quarter comes in at 254, the estimate 250. The outlook, listen to this. They now see the full year revenue outlook of about 93 billion. They had seen about 97. The estimate was 96.63 billion US. So that is a downside surprise, Bramo. That stock is negative too. We're down by 2.61%.
It's not entirely surprising given what we saw with Uber and the freight services, given what we've seen on the peripheries. But there is this larger question, and it goes back to whether we're dealing with disinflation or deflation, this concept of when do goods and services meet? Goods, you can see there is this slowdown, there is this recession that does persist, and people are not sending around as many packages. On the flip side, services keep going gangbusters. At what point do we see some sort of convergence? And right now, it seems like goods are still on the back foot.
We'll come back to that a little bit later. UPS negative in the pre-market by a little more than 2.5% this morning. Equity futures on the S&P 500 negative by about 0.5% on the S&P. Yields all the way in, down 9 basis points on a 10-year. It's a break of 4%, 3.99. Elisa, 3.99.59 on a US 10-year.
We were talking about trade, and we do get some trade data at 8:30, but I'm actually more interested in some of the Fed speak. Philadelphia Fed President Patrick Harker, who speaks around 8:15 a.m. Richmond Fed President Tom Barkin around 8:30 a.m. To me, the key data point of the day are some of the metrics underpinning the auction at 1 p.m. The U.S. is planning to sell $42 billion of 3-year notes. This is the first of 3 auctions that consist of the $103 billion that the U.S. Treasury is selling, up from the expected $96 billion. If these go well, does that fuel a risk-on kind of move? If these go poorly, could this determine the risk-off kind of feel for the rest of the week? And today, earnings continue. Lyft, Rivian, AMC, Bumble, Duolingo, iRobot, all of the ones that we know and love. I find it interesting, how much do we see consolidation among the big winners? Lyft shares lower by 0.5% so far this year. Uber shares up 82%. Rivian, the electric vehicle maker, up 31%, 32%. Tesla up more than 3 times that. Do you see that ongoing consolidation, or do you see some of the second runners up, I should say, really make a push for it?
The day ahead from Lisa. Lisa, thank you. That's the day ahead. The earnings coming out a little bit later. Dean Kernick joining us now, founder and CEO of Macro Risk Advisors. Dean, great to catch up with you, sir. Looking ahead to the issuance coming out through the week. Lisa mentioned today the 3-year, Thursday the 30-year. It's going to be a big focus for a lot of people in this fixed income market. Do you see any problems on the horizon, Dean, taking down that additional supply from the Treasury?
Certainly difficult to know, but it's a theme that's come very quickly within the market's crosshairs. Let's just step back and look at the 2 steepening episodes that we've seen, the sort of disinversion episodes that we've seen this year. The first was March. That was SVB. That was really all about the front end, right? We had a gigantic move higher in the move index, the VIX for rates. Short-dated rates came down a lot. This is different. This is really the long end, and I think there's a confluence of factors. It's Fitch, which is a kind of a Captain Obvious moment. We know the U.S. is on an unsustainable path, but it doesn't help to hear it. And Janet Yellen's protestations aside, everything that Fitch wrote is kind of spot on. And then you point to supply. So it's going to be interesting to see the ask of the folks that have to own this paper to buy it at a time when the price momentum and the trend is higher in yield. And you also just referred back to the banking system. Banks don't work well in a deeply disinverted curve. And, one way to uninvert the curve is to have the long end rise, but that doesn't really help either. You're going to have maybe not SVB-like implosions, but folks are nursing losses on long end paper, and the backup in long end yields doesn't help.
I like the idea of nursing losses. Let's look out forward 1 quarter, 2 quarters, 3 quarters, Dean Kernick. What I see is a linkage here of less volatility, a quiet in volatility, and suddenly a quiet in price change of deflation. Forward, how do you play? What do you do given less volatility and less price change?
Yeah, it's a great point, and that's, I think, been a theme that's persisted for most of the year, which is, again, post the SVB tumult, markets really settled in. We're talking about realized volatility levels in the S&P consistently below 10. Those are not the dreams that long option holders are made of. It makes it very difficult to pay premium, even as the VIX came down to 13 or so. It makes it just very difficult to expend premium. And a lot of what's going on here underneath the surface of this low volatility is this profound decrease in correlation among stocks. You had the correlation of stocks in the S&P reach 8%. Just look at Friday. You know, the NDX is down 50 basis points on a day that Apple's down 5%. And you can just look at it and say, okay, well, Amazon's up 8%. You shouldn't really count on that kind of offset. And so one of the things I'm just a little concerned about is this gift of diversification that's just been very powerful. Again, the zigging and zagging of stocks is a testament to the power of diversification, but I don't think you're supposed to count on it that much. And I also want to step back and just comment that prices can just be so disparate versus, you know, the ultimate realities. And for Apple, for example, this $3 trillion stock, obviously everybody's got to own this thing. The cost of hedging Apple stock out 1 year, so fully 1 year's worth of insurance got down to the lowest of all time just before the earnings. And so you had this opportunity to insure the stock at an all-time high with the insurance cost at an all-time low. And I can tell you that nobody did it. You know, no one wants to expend premium when things are going so well. So, you know, our focus is really to try to understand these this low correlation, pay a lot of attention to the back end of the yield curve. That's definitely a concern. And then, of course, watching the development of inflation metrics is going to be critical as well.
You mentioned the yield curve in relation to banks. You also mentioned the post-SVB reality of VIX going way down. Although during the SVB meltdown, we did see a pickup in implied volatility. How much do you see this sort of ongoing grind in the small banks, in the regionals, as John started the show with, this idea that Moody's is downgrading names that are staples, PNC even put on watch for downgrade, Bank of New York Mellon, U.S. Bancorp, some of the staples of the regional banking market. We're really just across the board still seeing risk there.
Yeah, I'm certainly not an analyst for small banks. I will say that ratings agencies are often criticized as being kind of last to know and so forth, but sometimes they can catalyze an observation that something is wrong from a business model standpoint. And, you know, as the Fed has gone through with this tightening cycle, I think the most basic view has been, okay, they're increasing the cost of credit, right, just by raising interest rates. But there's also a supply side, and the supply channel gets kind of broken when yield curves are this disinverted, and the cost of acquiring the deposits that ultimately get lent out are this costly. So the supply of credit, I think, is worth focusing on a lot. Again, you're nursing losses at the long end from paper you bought in 2021 at extremely low yields. You're trying to ride it out. You've got this hold to maturity bucket, but it doesn't make the ability to supply credit very easy. Right. So I think that's part of potentially the Moody's downgrade as well.
Not everything's going to go down. Where's the opportunity right now?
Yeah, look, I think at the end of the day, you know, stocks do well in the long run. And what you're trying to do is just keep yourself exposed to risk, you know, in a broad, diversified way. Sadly, the S&P has really become much less of a diversified index than it has been historically. 28% of the index is comprised in the top 7 stocks. So that's something you've got to take a look at, you know, and just find a way to weather the storm. And to me, cash can be king, especially at 5% yields. So it's some combination, some mix of stocks and bonds to keep you in there. And I think, again, the risk is low volatility feeds into how you size your positions. You get too big at the wrong time. So our recommendation is, again, nothing that's earth-shattering. It's just to try to stay involved in the market. Don't get out of the market, but utilize the fact that cash has got a lot of optionality, especially at 5%, to stay in.
Hey, Dean, thank you for the update. Dean Kerner there at Macro Risk Advisors. Let's just get back to UPS just quickly.
Yes.
Stock is down by 7.5% in the pre-market. It's a cut to the outlook, TK, and they're blaming one thing, aren't they? They're citing it directly.
Well, yeah, they're the Teamsters. Here's the headline, folks. It's simple. We made a union agreement and it's taking it right out of revenue, and they're going to adjust as they go. That's a one-off adjustment, John. I get that. But the question is then forward from here, how do you create revenue growth? And what I would suggest, given deflation and given the gift we've had of a boom nominal GDP economy, people that have been growing at 8% are going to start growing at 5.5%. People that are growing at 6% are going to go right back to that moldy 2-3% revenue growth of before. And you're going to see that adjustment forward here. Yeah, granted, it's after earnings season, but with UPS, with FedEx, and with Home Depot and the others, we're going to see this. The revenue dampening is going to be there, whether it's Teamsters or not.
We're seeing that in the outlook this morning, Lisa. The stock is down by, let's call it 6% now.
Which raises questions, who's next? If Teamsters wants to go after some other companies, and it raises a question whether this is a template. The earnings need to go more to the workers in order to make the unions happy, and we have seen that consistently. How far can they push it? And how much does UPS get beaten up in terms of what it can invest in going forward?
They're supposed to raise prices. That's the theory.
Yeah.
That's the theory. They got to raise prices 3%, 5%, 8%, whatever.
I always expect you to say something more than what you say sometimes.
I think this is really important. I'm glad, John, you went back to UPS.
Then I start talking and you just
logistics is a big deal.
Talk all over me. Vicky Chada at Deutsche Bank in the next hour from New York. This is Bloomberg.
London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Earnings season is here.
Decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it.
They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
I supported raising the federal funds rate at our July meeting, and I expect that additional increases will likely be needed to lower inflation to the FOMC's goal. I'll be looking for evidence that inflation is on a consistent and meaningful downward path as I consider whether further increases in the federal funds rate will be needed and how long the federal funds rate will need to remain at a sufficiently restrictive level.
We've talked about this a few times. There are two phases to this. Phase one, get rates up really quickly. Phase two, sit there and hold. And Michelle Bowman doesn't think maybe we're done with phase one. That was the Federal Reserve governor. At least one official still looking potentially for more hikes later this year. From New York City this morning, good morning. Here's the equity market, the price action. Stocks down here by 0.4% on the S&P. Some downgrades of US banks in the mix, which we'll discuss throughout this morning. And some misses out there as well. UPS cutting its outlook for revenue. The stock is down by 5.6%. That's recovering just a touch. This from Reuters going into earnings from the Walt Disney Company after the bell on Wednesday, so tomorrow after the close. This according to Reuters, Disney creating a task force to explore, guess what, Tom? AI and cut costs. I think the cutting costs are the more interesting part of this. Where is Bob Iger and the team going with this? What is getting sold over at the Walt Disney Company?
MBA 101, if you see the phrase task force, duck or run or do both. I mean, it's Task Force Tuesday. John, I'm going to suggest you're going to see a lot more of this coming out here. There's going to be a task force here, a task force there. Task force are just big committees, I think is how you put it. I'm pretty cynical about it. All the triumph of Disney, Mary Poppins a million years ago, celebrating Sound of Music. You think Sound of Music was put together by a task force?
I didn't know that was Disney.
Oh, yeah.
I didn't
The
know
Hills
that.
Are Alive with the sound of a task force.
With the sound of Disney and
A task force.
Oh, you don't sound impressed by this
Surveillance,
task force.
I'm not. Task force is one of my least favorite phrases, task force.
There are some interesting things that could come out of a task force. They've been looking for a strategic partner from ESPN. What does that mean? When does that transpire? Does that mean a wholesale sale? And it also highlights that content is king. That died. And that is sort of the new reality that we're facing.
We're seeing some markdowns this morning. Joe Feldman over at Telsey Advisory Group looks at big box, what we're looking at with UPS and Home Depot and the rest. He marks down to market perform. Moments ago, Oliver Chenett Cowan took a dim view on Nordstrom and others. A lot of that's percolating. John, my data point, we didn't mention it at the top, the 10-year real yield with a vengeance from 1.80 down to 1.58. I believe that's deflation in the wind.
A nominal yield right there at 4%. I can't give you a quote from that movie, but 399.99 on a 10-year right now. We're down about 9 basis points.
We break 4,
in the Treasury market.
Yeah, there we go. Politics. Washington, amid all this unsettlement within finance, there is unsettlement in our nation's capital. Terry Haynes joins us this morning for a brief. He's with Pangea Policy. Of course, it's August, Terry. The doldrums in the global world. It's in that China has a legit slowdown, and all of that export and import dynamics with China falls over upon us. What should be our to-do list to repair our trade dynamic globally and particularly with China?
Well, firstly, we're going to have to continue. The United States is going to have to continue its efforts at diplomacy and be helpful. Secondly, I think the United States is going to have to be a whole lot more aggressive about trying to figure out what kinds of trade alliances it wants and with whom, not only in the Pacific, which is talked about a whole lot, but also enhancing its trade deals with both the European Union and the United Kingdom. And, you know, the United States has been a disappointment on all those fronts. Basically, nothing's happened in trade policy substantially for 2.5 years.
Terry, you've been a student of this. What is the character of our isolationism now? I'm going to suggest maybe that's led by the Republican Party, but I'm sure there's a lot of Democrats that agree as well. Is our isolationism now entrenched and similar to what we grew up with as kids?
Oh, no, I wouldn't call it, I'll attack the premise a little bit. I wouldn't call it isolationism as much as I would think of it as, you know, kind of not sure exactly how to engage. You know, the free trade era was kind of over even before the end of the Obama presidency, even if a lot of folks in markets and elsewhere didn't see it. Certainly politically that happened. The question is really kind of how to engage and what the most constructive way forward is for the United States. We haven't seen any efforts politically on that really in about the last 6 or 7 years. Even the renegotiation of the Canada-U.S.-Mexico agreements, you know, turned out to be basically a reshuffling of the deck. Welcome in a lot of respects, but still a reshuffling.
There has been a big shift in trade geopolitically, and we have seen the U.S. pull back from Chinese purchases. There is a question domestically about how much debt is sustainable, and this comes in a week where the Treasury Department is going to be selling $103 billion of U.S. debt. People are concerned about this. Is there any realistic conversation in Washington, D.C. about how to deal with the glut of sales and debt at a time when interest rates are going up?
Very little, I think. What we have here is a generation where a generation of politics where the received wisdom has been keep the status quo more or less from year to year on the top line federal spending. Continue to support the massive indirect federal guarantees, whether it be on housing, healthcare, anything else, and hope the problems go away. Frankly, but there's very little of that going on. Even what you hear from kind of conservative Republicans this fall, which will be part of what causes, I think, a likely shutdown of the government in the fall, is some sort of willingness to deal with that. But even then, what you've seen is the limits from people like McCarthy and Biden, where they'd like to talk about keeping domestic spending as a status quo, and maybe dealing with defense in a little bit less expansive way. At the same time, you've got all these geopolitical challenges, and you've got a consensus in both the Democratic and the centrist Republican parties that don't want to change anything. So that's a long way around to say, no, there's really nothing that's going to change about that in the short term.
Just to underscore what you just said, even though you think there is going to be a 60% chance of a government shutdown later this year, you don't necessarily think that will yield some sort of fiscal restraint in 2024.
Not meaningfully, no. I mean, even the most conservative Republicans talk about the starting point of fiscal restraint being a cutback to fiscal 2022 levels, which is a welcome first step, I think. But at the same time, that's a tiny step. You're not going to see anything seismic at all.
Terry, wonderful input as always. Everyone's a hawk until they get into power. It's a story of the last 20 years, isn't it? Terry Haynes of Pangea Policy. Terry, appreciate it as always. UPS, just an update on that stock. We're down here by 5.6% for UPS. An update on Apple as well for you. 5-day losing streak. Really tough stretch for Apple at the moment. It's down about 9% over the previous 5 days. Tom, we're just about positive this morning by 0.25%.
Two Apple things here. First of all, they are through 2 standard deviation. A lot of these pullbacks are very contained. I can't say that about Apple. Apple's clearly through the 2 standard deviation level. Also, our Mark Gurman has a rip-roaring Mark Gurman best-in-class worldwide note this morning on where they're going with M1, M2, and now they're going to roll out M3 for the laptop, John.
These are the chips, right?
These are the chips, the brain. Ex-Intel, building their own chips, M1, M2. John needs. And the offspring, Lisa, both of them, M3 laptops coming to a house.
How expensive are these?
It can be outrageous. They're outrageous, and the reviews are mixed. I'm telling you, the new Mac Pro, the fancy, recording studio computer, got reamed in the press. I mean, there's some product challenges here. Not to make light of it, not to be the fanboy.
Stock is positive at the moment, going against the grain of the last week, that's for sure. We're positive by 0.3%. Rabina Faruqi of High Frequency Economics joining us shortly. On the road ahead, CPI on Thursday, PPI on Friday, bit of Fed speak in between. Harker, Barkin later on today. From New York City, this is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Snapped a four-day losing streak on the S&P 500 in yesterday's session. Your equity market this morning looks a little something like this, with equity futures negative by 0.5% on the S&P, down about 0.5% as well on the Nasdaq. Lots to talk about on the UPS side of things. That stock negative by something like 5 to 6% through this morning so far, cutting its outlook for revenue, blaming Teamsters and union negotiations for some of the volume issues there. We'll talk about that later. In a bond market, 2-year, 10-year, 30-year, it looks like this. 2s versus 10s, negative 73 basis points at the moment. Only 2 weeks ago, that was negative 100. A lot of that lifting, the heavy lifting, has come from a 10-year yield that drifted higher, back towards 420. In the last couple of sessions, it's come back in. We're down about 9 basis points this morning. It's a break of 4%, Tom. It's 399.59 on a 10-year.
It is. The data's important. And again, I'm looking at the 10-year real yield as the key, sort of the linchpin of looking at equities, bonds, currencies, commodities. I got a 1.58 right now. We're disinflating, we're deflating. John, we got to take 3 seconds here. Would you please explain the American audience? This would be as if Aaron Judge of the New York Yankees or Ohtani out with the Angels was somehow being transacted. Harry Kane, this is the day they're meeting once more.
Well, how many deadlines have we had?
Yeah, well, this is it, I guess. And the Harry Kane transaction right now is deflating. They're talking about 100 million euros. Does he get that money?
No. Tottenham get that money.
Explain that. For Americans, that's completely foreign.
Well, if you've got a contract, you're an asset in the football club. Or some people might say a liability. And you can sell them. You can sell them for money, and you get the money for that player. Then the player negotiates what their contract might be, 3-5 years, and you get paid weekly. That's how it works.
We had a legal case 40 years ago, Kurt Flood of the St. Louis Cardinals, which we did away with this basically, where you weren't owned by the club. You were free and individual contract. What does Harry Kane want here? How does he walk in the Tottenham locker room if they deny him his move to Germany?
I think it's going to be really difficult.
I'm fascinated.
Another year left potentially, and then on his way for nothing. How many years has he got left? 12 months on his contract, Tom, I think.
I don't know.
12 months. The potential that he leaves for nothing, which is the same kind of situation that Kylian Mbappe's in as well.
What would Adele do?
What would Adele do? I don't know.
I don't know.
She take
Adele,
the money?
She's in charge.
She take the money?
No, I don't know about the money, but she'll get him.
This is not about the money. He wants to win, and he's not winning at Tottenham.
Yeah. There you go. It's your football update today with John Farrow, our Premier League expert.
Totally unprepared for that. Under surveillance this morning, prepared for this. Moody's downgrading 10 small and mid-sized US banks, citing a dimmer outlook. The rating agency saying the following: rising funding costs, declining income metrics will erode profitability. The first buffer against losses. Asset risk is rising. How many times have we talked about this, Tom? In particular, for small and mid-sized banks with large commercial real estate exposure.
They mentioned 10 banks, John, 20 banks?
10 banks.
There's like how many, Lisa? 2,000?
More an outlook.
3,000?
Negative watch,
What's
Lisa.
next?
Well, and then how much does this sort of crystallize a feeling that already is percolating out there, or maybe isn't? And this is what's interesting. It's off the radar of everybody. This hasn't been something that people have been paying attention to. The banking crisis is over. And now you're seeing those shares of some of the companies that were named by Moody's drop by more than 2% as people game out what this means for their borrowing costs and what this means for their reputations.
I said this about Fitch last week in a Sovereign. It just turned the volume up on a conversation. You get the feeling it does that again this morning, Lisa, around the US lenders.
And at what point does that consolidate some of the data that we're seeing where credit really is being withdrawn? Although, that said, we were talking yesterday about that credit report that was coming out at 3 p.m. and everyone was talking about, oh, credit card debt, revolving credit. Turns out people are taking out more fixed rate loans like auto loans and mortgages. So go figure, because they're still getting them and they're still looking for them.
Elsewhere in China, weakness once again. The economic recovery just not showing great signs of strength whatsoever. Trade plunging, exports dropping over 14% year over year. The worst decline since February of 2020. And the regional breakdown, you go through some of these countries, Tom, it's like double digit down, down, down.
One fifth, 20%. It's just a basic idea. John, what I would state here, I think it's important, a single sentence buried in most of the articles is global trade. Clearly, China is a dominant part of that. But this is not just about China. It's about, I learned this, frankly, from, guys like Ken Rogoff and others at IMF, Olivier Blanchard. The basic idea here is everybody's got this country story, that country story. You know what? You sum them all together, is global trade off the ebb here, which is something that some have predicted.
One caveat, and this was in our story this morning, it's worth a read. The value of crude oil imports fell more than 12% in the first 7 months of 2023 from a year ago. If you look at the volume of crude oil imports actually jumped by around 12% in that time. There could be a slight commodity effect in all of this as well. Lisa, the thing that jumps out for me always with this kind of stuff, does this speak to a global economy that's not doing well or Chinese consumption that's underperforming? Do I focus more on the export number or the import number?
It's a great question. I don't know the answer to that, and it speaks to the Adam Posen idea of long economic COVID, that seems to be what China is suffering through. They're not just coming back to some of the spending patterns pre-COVID. At the same time, the Census Bureau put out this data in the past couple of weeks that U.S. imports from China were down 24% in 2023 from the same period a year ago. Guess where they're not down? In Europe. So you're seeing it really decline in the U.S., but not in Europe. So how much is this really specific trading partners pulling away?
I wanted to squeeze in this last story on Italian banks. They're down. Unicredit. Pick your bank this morning over in Italy. Look at Unicredit down 6.7%, Intesa down 8%. Elsewhere, stocks down by something like 7.5%. The government's proposing a 40% levy on windfall profits, basically a windfall tax. Right. The tax could reportedly bring in something like 2 billion euros. The government blaming ECB rate hikes for the surprise announcement, which is somewhat controversial because I'm sure the banks would be blaming low ECB negative interest rates for the last 10 years for low profits, and they might want a rebate on some of that, Lisa.
I couldn't make sense of this. They didn't release any official wording or guidance. 40% tax on excess profits, blaming the ECB because why not? This is the populist government in Italy. What does this end up leading to? I mean, does this end up leading to actual policy with a 40% windfall tax, or is this basically a shot across the bow to shore up populist energy?
John, this cold. Is there a Chase? Is there a Bank of America in banking in Italy?
Unicredit is one. That's like a universal bank.
So what do they want? If they're leading the charge on this,
I imagine they're very upset by it.
They're going to get this surprise tax.
As Lisa pointed out, this can change in Parliament. This can be challenged in the court. There's very little detail here. The objective here is to try and raise tax revenue, to help address a cost of living crisis, to do something about first-time buyers, to do something about people struggling at the moment.
Really, you think it goes right down to that level?
Without a doubt. That's what this is all about. It's a cost of living crisis in Italy and raising a tax revenue to address it. Now, if you believe these banks have made money purely off the back of interest rate hikes and not because of anything they've done with their business model, then the argument would be that you should levy a windfall tax on them. This is a one-off, and they shouldn't reap the rewards of something that's come from the ECB. That's going to be the argument. Other people might say, look, they've suffered for 10 years because of ECB having negative interest rates, and finally we're getting positive interest rates. Why wouldn't they make more profit, Lisa?
And other people might say, wouldn't it be nice to have a resilient Italian banking complex that actually could survive through the next crisis? I mean, if you want to put provisions on trying to shore up their balance sheet or something like that, I understand. Just to say, we need taxes, you have money, let's take it.
That's always the way. The Thatcher government did this back in, was it late 80s? I think it was.
To show how fictional this is, and I'm not going to bore people with the math this morning, but with David Folkert's land out in London, I calculated out where Italian lira would be versus euro.
Oh, yeah? Where?
Way weaker is the fancy math. unbelievable, the weak euro that Italy needs to prosper.
Are we talking like 5,000 lira?
I don't have it in my head right now, but the answer is, it's not like a nuance. It's like way weaker. That's under surveillance this morning. Three really interesting things of the time, and what they come down to is this idea of post-stimulus, where are we? Rubila Faruqi joins us now, Chief U.S. Economist, High Frequency Economics. Rubila, you've heard us talk here, and it all sounds like somebody's taking the punch bowl away. And it's maybe the fiscal punch bowl here, the fiscal punch bowl here. When President Trump says of President Biden, Bidenomics is not working, some would say that's stimulus. Are we needing to get ready for 18 months, 2 years of a lesser stimulus?
Good morning. Great to be with you. Yeah, absolutely. I mean, we saw extraordinary support from monetary and fiscal policy. And we are going to see the adjustment now on the other side. Monetary policy is already on its way. Probably